Right. Hello, everyone. Good afternoon. How's it going, guys? Am I audible?
So your voice is really low.
Am I audible, guys?
Yes, sir.
Yes, sir.
Yes, sir. Better.
Perfect. How's it going, everyone? If you all can also turn your videos on. Most people from yesterday have joined.
Good afternoon, sir.
Good afternoon.
Good afternoon, sir.
Good afternoon, everyone. All right, sure. I share my screen. Let's begin for the day. All right. So, like I mentioned yesterday, again, today also we'll not be going too deep into exam questions and all. We'll be revising a little bit of management accounting. That is MA from your ACCA knowledge level journey. Some of you might have learned these things and need to brush up on them. Some of you might be starting these things after a while and again need to get on the same page. So today's first half, at least, we're going to be focusing on getting everyone on the same page, and then we can build up from there, right? The only question I want to really begin with is, can anyone tell me what's the title of this subject when we say PM? What does PM stand for?
Performance
Performance management.
Performance management.
Performance management. And odds are, guys, that you'll come across two terms throughout your PM curriculum. And it's very important that on day one, we're able to tell the difference of them. So you're going to come across performance management. And the other term is performance measurement. Now, throughout your BM curriculum, each and every chapter, each and every topic that you learn will either be a performance management topic or a performance measurement topic. Now, what do we mean by these two terms? Performance management is simply to decide what to do. Whenever I have a decision to make and I do any sort of analysis, any sort of setup to understand what is the correct decision for me to make, that is a performance management technique, a technique that facilitates management, of course, and my performance, right? And performance measurement, as the name says, is to measure what is already done. So, of course, in an organization, or rather in today's day and age, we live in an information overload world. Each and every activity that your customer, your employee, your product, your performance, your production does gets measured. Using all this data, companies try and get an upper hand against their competitors in the market. So it's very important, as of course, and again, our role essentially, again, yesterday, I don't think we went too deep into where do people who excel in PM, APM kind of subjects enter. But business consulting, management accounting, liaison is a key role that people enter into. Your role then becomes to be a person who helps a company in their business aspect, core business, whatever products, whatever services they are providing. Of course, you as a professional can only help if you have the right data. So the ability to measure what is done so that you have a base of data for which you can make your decisions all falls under performance measurement. And with your data or without your data, whatever tools that you use to decide what should be the next course of action. Should we continue selling a product? Should we shut down our product? Should we shut down a factory? Should we exit a geography? Should we enter a new geography? All these kind of decisions specific to a business are made using performance management techniques. So if you pay attention to your textbook once again, most of your PM curriculum falls under performance management techniques. All these things are commonly performance management techniques. And chapter by chapter, we'll keep confirming that. Very little of performance measurement is covered at a PM level. At an APM level, should you choose to take up that paper, is where you all will be going much more deeper into measuring a company's performance. And when we say measuring a company's performance, again, we had briefly mentioned this. What all can we measure about a company, guys? Any ideas? What all can I measure about a company?
Growth,
Profitability.
profit,
Profits,
growth,
Going concern ability.
Growth, yeah.
growth, going concern, survival, yes. Or if I am putting it this way, I can check employee performance, how my employees are doing in my organization.
Risk
can
of the
check-
company.
Division
No,
performance.
a financial measure. Risk is a financial measure. You are trying to gauge the performance of something that is already done. So, say for example, every month end, a lot of us who are working, we have targets, we have KPIs, we have OKRs. These are different ways in which organizations measure their employees' performance. Then you measure your product's performance. Then you measure your company's performance in a competitive landscape, etc. Right? Company maybe like I told you all yesterday, there are different kinds of companies, and hence there are different kinds of measurements. Like if I'm a company which is not for profit, then of course no profit measures will help measure my performance. But if another company is for profit, then you need to use profit based measure. So when we go deeper into performance measurement, of course, we'll go much more deeper into this. But in performance measurement, you try to measure each and every aspect of your business. These are a few examples. All right.
Sir, can we measure liabilities in performance management? Company's
So
liabilities.
management is nothing to do with measurement.
No,
Management is
performance measurement.
your balance sheet will show your assets and liabilities, right?
Mm-hmm.
See, the idea of measuring something is that it's usually not easily quantifiable. Say, for example, if I ask you today, how well am I doing as a teacher? You cannot easily quantify it, or all of you will not have the same answer. But a company's balance sheet will always say the same exact liability for everyone. Okay. So the idea of measuring things is to find ways to objectively measure performance of people, of products that cannot be easily measured. Correct? So then that's why you see that in our feedback system here at Zell, there are objective measures. Okay, how fast was the class? How clear was the communication, etc. That helps a company gauge how well, for example, a faculty is doing. So it's always that whenever you talk to a customer service representative, they talk to you at the end, they ask you to fill a survey where they ask you similar questions. Okay, how well did the person do? So the idea is to measure performance of people, of products, of experiences, of services, which will be different from person to person. Fair enough? All right.
Sir,
Next
one question. Sorry.
Mhm.
If you got the two option A and B, which one is much better profitable for the company, which we can measure by the performance management? And the financial risk, financial performance, which we can measure by the performance measurement.
No,
Is that
in
correct?
performance measurement, it is everything qualitative, quantitative, external, internal, financial, non financial. You try and measure everything. Management is the decisions that are made on top of what you have measured. So I first measure, say, for example, the market size. Then I decide which is management on whether I want to enter a market or not. So they go hand in hand. It's not that one is better than the other. All right.
Yeah, okay, sir. Thank you.
Perfect. So another question to you guys at the end of the day, if I take everything out of my business and ask you one single reason, why would I do business? Why do companies conduct business? What
profit,
would be your answer?
To generate
Profit.
profit.
To generate profit.
To generate profits? I hope everyone is in agreement with this. The fundamental reason why a business exists is to make money. Then there are several secondary reasons to do with CSR, reasons to do with innovation. A lot happens. But one of the most fundamental reasons in traditional business setup is, of course, to generate profits. As a management accountant, as a business consultant, there's one of the most fundamental day one learnings that you need to know that there are only two ways to make money. One is to increase revenue, the other is to decrease costs. As simple as that. These are very basic learnings, but fundamental to everything that we are going to learn in our PM journey. That if you want to increase your profit, if you want to increase your bottom line, you need to increase your revenue, your top line. So find ways to increase your revenue, which then opens up to a whole thing. Okay, find new products, find new markets, change your pricing. So that's everything under increasing revenue. And then the other option is to decrease in costs, which is find ways to buy in bulk, outsource, whatever you can do, you do to find ways to decrease costs. So at the end of the day, your profits get increased. Correct? So again, everything that we learn in PM will either boil down to decreasing costs or boil down to increasing revenue, finding ways to do that. Correct? Everyone with me so far? Any questions? All right. So those of you who have done financial reporting, and again, everyone should be aware of the basics. But can someone tell me what are the 4 or 5 statements that a company needs to publish in their annual accounts, annual reports? What statements do we publish in a financial reporting?
Balance
SOP
sheet,
and
PL,
OCI,
balance sheet,
P&L,
cash
Statement of
cash
profit or
flows.
loss,
flow.
statement of financial position,
So I heard balance sheet, which in ACCA terms we call it financial position. Then
statement of
someone said
statement of
statement of
profit and loss,
cash flows. What else?
statement of
statement of
equity,
equity,
PL
SOP and
statement.
OCI.
statement of
Profit
changes
and
in
loss
equity,
account.
changes in equity,
Statement of changes in equity. I heard statement of profit and loss. And I think last one is simply narrative commentary. Correct?
so
Now,
this is notes to
again,
account.
sorry.
So this is notes to accounts. That's narrative commentary.
Yeah, same thing. Notes to accounts, narrative commentary. So these are again all statements that a company needs to do for compliance perspectives. These show historical records, things that are already done. A company is putting out an objective view to the world of what has happened using these statements. These are heavily governed using IFRS in IFRS's case, and every country like India, we have Ind AS governing our own version of these accounts. But essentially, these are compliance oriented. These are done because you have to comply with the world to be able to operate as a company, as a business entity, and take benefits of the country's economy. From a management accounting perspective, also, there are a few statements that we need to be aware of that we're going to start off and revise today. The very first one that we're going to discuss is a cost card, and second one is going to be a profit statement. Now, the beauty about management accounting, PM, everything that we learn here is all of this is to facilitate what we discussed. It is nothing to do with showing the world, okay, oh, hey, I have a cost card. It's all to do in a way that it helps benefit me and my company in whatever is it that I'm doing. So the objective of preparing internal reports, such as cost card, profit and loss statements, and much more, is to get an internal idea of what is happening to facilitate better decision making, better performance measurement. All right. So that's why there is no governing body, there is no format that I need to follow. So even in an exam, if say for example you're preparing anything that we learn in PM, there's no one correct way to do it. There's always a logical way to do it. So whatever logic you are able to make sense of, that's the right way to do it. And it is, so I'll give you all a quick anecdote before we go forward. So in my own exam, and that's a question that we're going to do sometime later in the weeks, I had a question where it was a theme park and they had told us in winter whether it should be operational or not. So yesterday when I was telling you that the exam is case study oriented, this is the kind of questions that can show up. That they give you a lot of financial data, some non-financial data, and they ask you questions like this. Okay, winter mein maintenance is higher, people come less often, so this will be the impact. Should it be operational or not? And you're supposed to give an answer. But now the beauty about these questions is Okay, some of the students exited the room saying, okay, obviously it was meant to be closed. That's the opinion that we were supposed to give. And I worked out, I had written, no, it should stay open. And then I had gone down a non-financial route. And at the end of the day, both the student sets were right. Here in PM, often case, it's not there's only one right answer in subjective questions. It's essentially the way you shape your answers and what logics do you use behind your answers, which comes into play. Correct? So PM is very open like that, which again should comfort you that, okay, you don't need to, go into, okay, this is the only way I'm allowed to think. You need to be open to the idea, okay, what I'm thinking can also be right. And that's where I come in as a filter. Okay, you keep submitting what you're thinking, and together we can shape that, okay, is your thinking aligned with what PM is expecting you to think, or is it something way out of the box and we need to work on it? All right. So for now, let's first focus on how a cost card looks like. And for that, let's take the examples of one of my favorite brands. The Starbucks. Now, any of you, can you give me a rough idea of how much a cup of coffee at Starbucks on average sells for?
250.
700.
300.
250, 300. Safe for me to say it's in this range. Correct? And all of us, especially Indians, when we walk into the store, all of us do the math, all of us have that thinking, okay, yeah, there is no way this actually costs them 300. Correct? And essentially, every single company on their back end have their own cost cards, where it gives them an idea of what their costs are, what their profits are, to arrive at that selling price. So let's learn how a coffee cup's selling price would look like using a cost card. So the very first components in a cost card revolve around direct materials, direct labor, and direct expenses. These three add up to what we call the prime cost of a product. So say if I were to ask you direct materials in a Starbucks coffee cup would be nothing but coffee beans, milk, cream, whatever is it that they're putting up there, 100 combinations. Everything, direct materials ka definition is anything that directly goes into the end product that you're producing and giving to a consumer is all part of direct materials. So now if they use things like oil to grease up their machines or any cleaning materials, all that is not direct materials. Direct material is whatever forms part of your end product. All right. Similarly, there is direct labor. Direct labor. Yes, your direct.
Also direct material.
Correct. Your cup, in case there's a packaging material. Khushbu, your coffee machine is an asset. We'll come back to it. If you want to clarify for yourself, think about it. Do you get a piece of the coffee machine when you buy the product? If no, then it is not a direct material. Your direct material is whatever the customer gets. Okay.
Basically, the
Sir, it's depreciation. Like more often we use it earlier.
That's indirect expense.
Correct. Anything that you don't get in your hands when you purchase the product is not direct material. Okay. So we'll come to what that is. But for now, understand what a direct material is, which is something that you get in your hand when you buy any product. All right. Similarly, we have direct labor. This is again, as the name says, any labor that worked directly on facilitating the production of your product. So in the case of Starbucks, again, it is nothing but your barista. Now, everyone else, people in the supply chain, the farmers, the cleaners, the admin staff, all of them fall elsewhere. They are not direct labor. Direct labor is nothing but the labor which again facilitates the use of these materials, converts these materials into the condition of the cup, which is the cup that you buy. So the barista and any other direct labor is part of the direct labor in your cost card. All right. Khushbu, sugar, etc. will also be direct material. Think of it as anything that goes in the cup is direct material. Okay. Finally, there are direct expenses. Now, direct expenses is anything which is direct in nature, but not part of material or labor. This commonly includes taxes, royalty, etc. Anything that is paid per cup sold. We pay GST to the government per cup sold. We pay royalties per cup sold is part of direct expenses. Can anyone tell me how is Starbucks operating in India? Does anyone know who they have partnered with?
Tata.
Tata.
Tata. So every cup of coffee that Tata sells in India, they actually pay a royalty to Starbucks, the brand in Seattle. So all those royalties per cup sold that are getting paid are part of direct expenses. Correct? Again, anything that is direct in nature but cannot be classified as material, like royalty is not material, it's use of brand image. Correct? So that falls under direct expenses. These three added up give the company their prime cost of production. Correct? Let's go a little further and then we'll stop for questions. After direct, all we are left with is indirect. In costing, we commonly call indirect costs as overheads. Now, there are two kinds of overheads. Either they are variable in nature or they are fixed in nature. So we include both of them. Correct? Now, your variable overheads are nothing but all the costs that are indirect but also variable. For example, electricity. If in a month one of my cafes is shut, will I pay any electricity bill, guys?
No.
No. Okay. But when my cafe is running and I'm paying an electricity bill, is there a way to quantify that yaar, itna electricity must have gone in making this cup? Is there a way to do that? No. So things like electricity fall under variable overheads. All right. And anything that is payable, regardless of what happens in business, which is essentially things like rent, things like maintenance, all fall. So your assets, depreciation, all of it, if you want to include, falls under fixed overheads. Now, if I have taken a cafe on lease, again, if a month I've not opened my cafe yet, do I still have to pay my rent on it? Yes, I do.
Yes, sir.
Correct. So it is not variable in nature. It is fixed in nature. But again, I cannot say that my rent was per cup of coffee sold. So it is not direct. It is an overhead or an indirect cost. Correct. So when I add variable overheads to my prime cost, I get something known as variable production cost. And when I add my fixed overheads to it, I get what I call as total production cost. Any questions so far, guys? Everyone with me so far? Yes or no?
Yes, sir.
Yes, sir.
Perfect. So after production cost, I'm only left with one component, which is all costs that are not related to production. All right. So your non-production costs are commonly categorized in three things: administrative costs, selling costs, and distribution costs. So what are these? Administration costs are nothing but your ground level manager to your central office to your headquarters, everything, anything that is administrative in nature. Again, nothing to do with the production. It's to do with running the day-to-day business of the company. Correct? So no example specifically here, but think of headquarters costs, think of managers, think of IT assets, softwares, all these kind of things fall under administrative costs. All right. If they are like Starbucks has an app which they are running, correct? That app is nothing to do with, of course, the product. It's an administrative cost for the company, correct? Selling and marketing costs involve marketing campaigns that I run, any discounts that I give, or in say not in Starbucks case, but any incentives that salesmen have. on selling a product. All these kind of things fall under selling costs. All right. And distribution finally is the part where you facilitate consumption. So distribution is thoda tricky. Let's say for Starbucks case, what is the appealing part about Starbucks besides their coffee, guys?
Unique name written on.
Brand name.
Brand name, the experience that you go in when you walk into a Starbucks store, everything like that.
Ambience.
Ambience, right? So distribution facilitates consumption. So say in non-Starbucks cases, say for example, I'm Kruma or something like a Vijay Sales and I'm selling TVs. Can I buy a TV and start using it immediately? No. Someone will have to come to my house, install that TV. So now it's in usable condition. Someone will have to ship it to my house. So shipping, installation, and in businesses such as those of Starbucks, things like ambience, infrastructure, like infrastructure as in take services businesses, where you go at salons, where you go for massages, anything like that. All of them also only facilitate consumption by having a good distribution. You wouldn't want to go to a shady place where you are, worried ke how will the experience be. So the more they spend on distribution, the better it facilitates consumption of whatever product they are selling. So all that falls under distribution costs, which essentially give me a total cost of my product. Everyone with me now? Any confusion about any cost that does not fit into any of these? Rishabh, depreciation is not a cost, right? Depreciation is an accounting treatment. When you are including your assets in fixed overheads, they themselves are essentially your representation of your asset. All right. So I'll come back to that. But depreciation is just an accounting entry. Okay. Any questions, guys? Now, any guesses how much in a percentage terms is 1 cup of coffee in terms of total production cost? If I ask you the production cost of a cup of coffee for Starbucks, how much do you think it is?
30%.
Less than 30.
20.
Sorry,
20%.
18 to 20%. And that is also because they associate the costs of sourcing all these authentic and whatever ethically sourced coffee as costs which are direct in nature. Whereas technically, even those things should fall under distribution costs, correct? But imagine only 18 to 20% goes in this, but this is not their profit margin because for a brand like Starbucks, they spend a lot of money in non-production costs, correct? So it's not that they are minting money. Of course, the experience that you get is all incurred in non-production level. And then they must have their, right? I'm sure they have 30, 40, 50% margins still. But of course, if you look at their cost breakup, their production cost is only 18 to 20%. And that's why whenever we compare coffee, we see how someone's able to sell something similar quality for $100 because they don't incur so many non-production costs. Right? Yes, Kushbu.
Sir, like these are franchisee stores. So the deposit or the money they pay for getting the franchisee would be differentiated or classified in which cost?
Direct expense. Without getting that franchise, am I able to sell the Starbucks coffee?
No.
So it's a direct expense. And again, if you can't distribute it per unit sold, then it would be a fixed overhead. And that's the beauty of costing, right? Business to business, your classification will change. Like you correctly gave an example, I can be a store-owned business or I can be a franchise. So of course, store-owned business does not incur a franchise fee. So from business to business, the definitions will change. Okay.
Thank you, sir.
Perfect. All right. Last step before you go from total cost to your selling price is simply to add a profit percent. Correct. So another thing we need to revise from our MA journey is profit is commonly done in two ways: margin and markup. Margin is always on selling price. So whenever people say, "Okay, yeah, I'm selling this for 2,000," often your person will ask, "Okay, margin kya hai? How much are you earning?" So we often calculate margin on selling price. Markup is calculated on cost price. So what do we mean by this whole point? Let's say my total cost came to 120 rupees product, and I tell you that, Rashesh, I as a company want to earn 30% mark. What would that mean? If I want to earn 30% markup, and let me write this clearly here for everyone. Let's say my cost price is 120. My profit, I want to make 30%. So I'll write it here. So what will my selling price be? So all I need to do is I need to take a placeholder. Let's say a scenario where I say my cost is 100 and my profit needs to be 30 on top of cost. So my selling price has to be 130. Now, using this as a cross calculation, I can calculate my profit, all my selling price. It's basically cross multiplication. All right. So what should be my selling price? My selling price should simply be 130 divided by 100 multiplied by 120. Correct? Or simply, if I want to find out my profit, it should be 30 divided by my 100 multiplied by 120. Correct? And you see 120 plus 36 is coming to 156. And now I know you all will say markup is easy to calculate. It is simply 120 into 1.3 or something, which is also all correct. But I only want you all to ensure that you all don't confuse yourselves between margin and markup. All right. So everyone clear so far with how markup works?
Yes. Yes.
All right. Now let's quickly understand how margin works. So same thing, it's basically a cross calculation, but the only difference is when a company wants to earn a margin of 30%, it is often it's always on selling price. So where my selling price will be 100, which means my cost, if I'm using placeholder figures, becomes 70. Now my cost was still 120. Again, if I do cross multiplication, I'll be able to arrive at a 30% margin, which in my case, now this product comes to 171.42. And let's confirm if the profit is also correct, comes to 51.4. And again, if someone wants to check, they will be able to check 171.4%, 171.4 selling price pay. If I take 30% margin, I earn 51 rupees, which means my cost has to be 120. Correct? So if a question tells you margin and they've only given you cost, you still can do it. If a question asks you for markup, you can still do it. All you need to do is construct a placeholder value and then cross multiply. Any confusion here, guys?
Can you repeat the margin part again?
Sure. Margin is on selling price. Okay. So when I say I want to earn 30% margin, it means for every 100 rupees in revenue, I want to earn 30 rupees in profit. So if 100 revenue and 30 is profit, my cost naturally needs to be 70. Once I have constructed a scenario, I have the figure of 120 given to me, right? So at 70 rupees, if my profit is 30, at 120 rupees, my profit should be what? Is what I calculate by cross multiplying, which is 30 divided by 70 multiplied by 1. All right.
Okay, done.
Any confusion, anyone? I hope everyone's with me so far.
Hi, sir.
Yeah, Parul.
Sir, is there any other way, like shortcut for solving this? Like, I understood this, whatever you said, but any other shortcut? Like,
This is a shortcut that I'm giving you. Na? Okay, you always construct a scenario. So you will guarantee get it right. Even though this is a revision topic, in a lot of MCQs, they ask you the answer in margin or markup terms. They can ask you the selling price, they can ask you the profit, and you need to be able to do this correctly. Varna, imagine you do everything right and you get the last bit wrong and you lose your full 2 marks of an MCQ. Correct? So you don't want that scenario. So getting this right is better than looking for a shortcut. Okay?
okay.
Perfect. All right. So if I say selling price for Starbucks a cup is 300, sorry, and let's say Starbucks wants a 55% margin. Can you guys on chat tell me what the cost price should be? Right, I'm getting a lot of answers. So I'm getting two answers, 135 and 156 or 165. 135, I believe, is the correct answer. Right, just to do it for everyone as well. Like I said, even though it's a simple thing, I always prefer constructing scenarios. So 100 is my selling price, 55 is my margin, so 45 must be my cost. Since my selling price in my question is 300, all I need to do is do a cross multiplication, correct? So 45 divided by 100 multiplied by 300, my answer is 130. All right. I think everyone's gotten the hang of it. Any confusion, anyone? Shall we move forward? I hope everyone's clear with how a cost card looks like.
Yes, sir.
Perfect. And if anyone wants to keep the textbook open, like I said, I don't use the textbook much unless I need the questions. So you're on your chapter 0 and we've covered our cost. All right. Yes, Nikki. Nikki, you have a question? You're muted. Nikki, do you have a question? You're
Was
muted.
me. Yeah. Sorry, sir, but this question I don't understand, which you gave us to calculate.
If the selling price is given as 300 and the
Yeah.
company wants to earn 55% margin, what is the cost price of the product? So you're
So we
finding the
have to
cost
do.
price of 135. You didn't understand the question or how to solve it?
Hmm?
You didn't understand the question or how to solve it?
How to solve it?
So if I say that my selling price is 100, sorry, yeah. If I say that my selling price is 100 and the company wants 55% margin, what will my cost be? 100 minus 55?
45, correct.
Now in the question, they've given that the selling price is 300, correct? So I need to find this as my missing figure.
Okay.
How do I do that? I cross multiply. When 45 is the cost at price of 100, what is the cost at a price of 300? 150. Got it?
Okay, perfect. Yeah, thank you.
Perfect.
So one more thing, like by this 55% margin, if we minus this 55% margin out of 100, so we know that 45% is our cost. So can we directly calculate the 45% of 300, which gives us 135?
Yeah.
Can we do that?
Correct, no? I think so.
No.
Yeah, that's the point. Na? There are there are many ways to do it. The idea is fundamentally the same. Okay, 45% cost is what we are representing. So you get it any. All right. Okay, moving forward, using a cost card, we are able to make something that we call as a profit statement. We call it a cost statement, profit statement, same things, interchangeable words. So next, let's learn how a profit statement looks like. Now, as I said when I started the class today, to be able to earn profits, what are the two components that any business needs? Revenue and costs.
Increase the revenue, decrease the
Revenue.
cost.
Correct. So those are the two things that we have to demonstrate here as well. So a profit statement simply starts with revenue, which is nothing but units sold multiplied by selling price. All right. Just a moment. Yeah. Let's move this here. Yeah. So revenue is nothing but my units sold multiplied by selling price, from which I have to deduct what we call as cost of production, cost of goods sold, cost of sales. There are several terms. All right. Let's call it cost of sales. Now, what is cost of sales? Cost of sales is nothing but my opening inventory plus any production in the month minus any closing inventory. Now, why do I do all this effort? Simply, let me ask you guys a question. Say, for example, I am selling, let's say, pens. All right, I'm selling ball pens, and in a particular month, I produce 5 ball pens at 10 rupees cost, and that month I sell 2 ball pens at 20 selling price. So guys, have I made a profit or have I made a loss?
Loss.
Anyone thinking loss? Anyone thinking profit?
Profit.
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 Why profit? Why loss? If you can justify your answer.
Because you still hold 3 ball pens, right? You can sold in future.
Because we have inventory of 3 ball pens.
Correct. Please remember, guys, inventory has a role to play. In accounts, we must have learned something called as the matching concept. What is matching concept? You match your revenue to the cost of units sold. If I've made 1,000 units but sold only 2 units, it does not mean that those 2 units sale represent 1,000 units cost. Correct? So to match, you do this. Say, for example, I sold 100 units. My opening inventory was 50 units and I produced 250 units. Naturally, my closing inventory has to be 200 units. Only then will my profit statement match for the 100 units that are sold and the 100 units that were used. Okay, the company will still show 200 units in closing inventory, which can be opening in the next period, and the cycle keeps going on and on. So to ensure that matching concept is followed, you do your cost of sales as opening plus production minus closing inventory. Any questions here, guys?
No, sir.
All right. So your opening plus production minus closing comes out to your cost of sales. Your revenue minus your cost of sales gives you nothing but your gross profit. All right. Now, one thing that you all need to, yeah,
Sorry, but this cost of sales in the outer column should be negative amount, right?
yeah, it's negative only. Just, yeah,
Thank you, sir.
perfect. All right. So, as I was saying, now only thing you all need to remember is inventory is always valued at production cost. Correct? Let us write that here. Inventory is valued at production cost, right? So in our costing, in our profit statement, which costs have I still ignored?
Non-production.
Non-production cost.
Non-production cost. So that's the only part I will now deduct. Once I deduct my non-production cost, I get something called as net profit. All right. So I took everything till my production cost and included that here, which gave me my gross profit. And then I proceeded and I deducted my non-production costs also, and I got my net profit. That's how a profit statement looks. Again, we've learned similar versions. If you remember your 12th accounts, we used to learn trading and P&L accounts. So all these are essentially the same versions of the same logic. Your production related profit needs to be known, because companies, when they start their journey, this is what they focus on. Because initially, because they've incurred a high amount of expense setting up their shop, setting up their store, their front, whatever it can be, they incur a lot of non-production cost at the start. But they know that as long as fundamentally they are making gross profits, eventually they'll be able to overcome the non-production costs and take the company towards net profit. That's the reason why we distribute these two things and we prepare our profit statement in this manner. All right. Everyone with me so far, guys?
Yes.
Okay, perfect. So now my question to you all goes, okay, all these costs may, say for example, actually let's do it with an example. Maybe my material cost per unit, again it's the total of the material that goes in a product, is 10 rupees. Maybe the labor per unit, let's say something like 20 rupees. Maybe expenses are something like 8 rupees. Maybe variable overheads, I'm just putting random numbers, is 25 rupees. The problem comes when we reach fixed overheads. Say, for example, my rent per month is 60,000. So, does this mean that my total production cost has to be 60,063 per unit?
Divided among the number of units
produced.
Correct. So, I'm sure you'll agree that that's not the case. Something needs to be done about this, but of course, I cannot include it here. Correct? Because it's a total figure and not a per unit figure. Correct? So one of the common things that we do and which introduces or we are revising absorption costing method is where we divide this fixed overhead by the number of units and we come to something known as OAR. OAR is overhead absorption rate. So say for example, I think I will sell 10,000 units and my fixed overhead is 60,000. My OAR is nothing but my fixed overhead upon budgeted production or sales. So it is nothing but 60,000 divided by 10,000 and it comes to 6. So I convert this into a per unit figure and I include this here. Sounds more logical, guys?
Yes, sir.
Yes, sir.
Okay. Please remember one fundamental thing here, that it's rate. We call it rate for a reason. A lot of times, the moment we distribute this into a per unit cost, we forget that at the end of the day, the amount we actually have to pay is still 60,000. Correct? ऐसा नहीं होगा कि we sell 5,000 units, so suddenly the payable becomes 6 into 5,000, 30,000. the amount we actually pay at the end is still going to be 60,000. Correct? That's why we call it a rate and not a cost, as costs are generally flexible. A rate is just a conversion. That's why we call it conversion rate. Correct? Tomorrow, if my sales becomes 5,000 units, my rate will change. So any change in my end unit sold, my rate will keep on changing. Fair enough? So that's the only fundamental which sets up absorption cost. You're absorbing it using a rate, and that causes you to do some adjustments later on, which we will come to next. Yes, let's stop for questions. Yes, Zoel.
Sir, it means our total cost is not correct, like 100% correct.
Yes, of course, because you do your cost card ka activity at the start, correct? But you only know all the details at the end, right? So of course that needs a little bit of a correction. So to give you that one clarity, let us say cost card is prepared at the start, profit statement is prepared at the end of a period. Okay, so start में तो you don't know how much will you exactly sell. एक दो यूनिट भी ऊपर नीचे it can happen, but at the end, of course, you know how much you sold. So you do a little bit of a correction at the end. Fair enough, Zoe?
Yes, sir. But
Perfect. Hariharan, the textbook is on the LMS as a soft copy, and you can download it from there. Yes, any questions, guys? If you don't ask questions, I won't get time to drink water. Yeah, पूछो थोड़ा.
So what do you say? The cost card is prepared at the start, right?
Yes,
And the profit statement is at the end.
correct. Correct. We'll go into a question now. So anyone who's having that 5-10% confusion, with the help of a question, we'll get it more clarity. Okay.
Sir, I have a doubt. If
Yeah.
cost card is just an estimate and it could result that the actual sales or actually over which rate we have divided our fixed cost may differ. So ultimately it can lead that we incur a gross loss, not net loss, but gross loss.
Correct. You're right. So that's why whenever you start, your first estimate is always usually wrong. But the more you understand, the more you forecast, the more you will get accurate. It automatically fills in. Correct. So odds are that the first time you ever prepare a budget, it's not going to be as accurate. The more you keep doing it, the more it starts becoming accurate. Okay.
Could you explain short overhead absorption rate?
Sure. So, like we just discussed, it's not possible for me to take the full overhead in a cost card. So I need to take something that represents that cost instead of ignoring that cost. Correct? In absorption costing, you use OAR, which is an overhead absorption rate, which converts your fixed overhead into a rate that can be applied per unit basis, which is simply a fixed overhead total divided by number of units, or there are 2-3 more things, but that's the essence of it.
Thank you, sir.
Yeah. Any other questions?
Sir, as you said, the first or the second estimates will be wrong as we don't have the experience or we don't know. And if it is a new business kind of, and they use the markup approach over the cost, then if they keep varying their selling price, won't it have a negative image of the business over potential customers?
No. So remember one thing, okay, while I'm a new business, I will know my base. Like that's where again there's a chapter of dealing with risk and uncertainty, where we understand how accurate our forecasts are. Correct. So I will of course do my research. I will see in an area what are my competitors, how many units they sell, and I do conservative estimates for how much I will be able to sell. And then of course thoda upar niche it will happen, but it won't be that I thought I'll sell 1,000 units and I only sold 5 units. It will never happen like that. Correct. And initially, of course, companies absorb the initial loss as they are experimenting and understanding what works for them. All right.
Okay.
And then you see newer companies also sell at near cost prices as end of season discounts and stuff. Because of course they want to recover their fixed overheads, even if that means they can't make profits just yet. So that's the whole beauty of business, right? That there are always ways forward. But the idea is to keep learning and keep improving. Yeah.
Okay. Got it.
Yeah.
Thank you, sir.
Yeah, go ahead.
Sir, so our total cost is estimate or actual cost? Because apart from fixed cost, everything is actual. OR, apart from OR.
Everything is an estimate. At the end of the day, you don't think your material price can also go up during a month?
Yeah, it can work.
Correct, right? Everything is an estimate, and that's where again standard costing comes in, where you compare how well did you estimate it versus what actually happened. Correct, but at the end, for now, cost card is an estimate. Okay,
Okay. Now got it.
perfect. Okay, if there's any confusion, let's do a question so you all will get that perfect idea. Let's pay attention to illustration 1 in chapter 0 for absorption costing. I will take this question with me in our Excel. Please take a second, glance at this question. Right. Let's solve and walk through it together. The end requirement is they want us to make a cost card and a P&L statement. Okay, so let's start with the cost card because we need our cost card anyway for our P&L statement. The very first thing that they've given us is direct material. So this company makes chairs. So we are making a cost card per what, guys?
Per kg?
They're making chairs. So what's my unit of
Per unit, quantity one.
per chair? Okay. So this is a cost card per chair. Each chair requires how much material
3 kg.
3 kg.
and how much each kilo costs us?
$5.
So as simple as that, you prepare your cost card. Similarly, we have labor. We take 5 hours. It costs us $2 per hour.
$2 per hour.
Then we have variable production overhead, $4 per unit given to us. And then we have production overhead. So fixed may you read now. Budgeted activity level is 15,000. Activity level matlab what they expect to produce. They expect 15,000 chairs a month. And budgeted fixed production cost is 30,000 per month. So I can calculate my OAR as 30,000 divided by 15,000. Correct? This is in what terms, guys? Per unit?
Per unit.
Per chair per unit. So my fixed production overhead as an OAR is 2. Correct? So for my total production cost, any other cost that I'm yet to include? These are non-production costs. And the actual cost will come to when we prepare our cost statement, because at the start, you of course don't have this information. Correct?
Yes.
So as simple as that, our cost card is here. Okay. Please stop me if there are any questions, any confusion. Next, let's prepare our P. Yeah.
Sorry, but in this cost card, why we didn't include non-production cost?
So your cost card, you can write it here, but we know that we have to include it in the P&L statement after only, right? So even if you write it here, it's after the production cost. So it's okay if you show your cost card only till your production cost. All right.
Means we don't have to include this non-production cost. It's okay, like.
So 1 second, let's avoid every confusion. Let's add it. Okay. So let's say variable non-production cost and fixed non-production cost. Okay. So even if I add this, my total production cost will not change. Correct? So let's say and 2500 divided by 15,000. Okay.
Yes.
So idea is that since you're taking a production cost in your P&L statement and then you're directly deducting your non-production cost, this is just wasted lines for you. Okay.
So from cost card, basically we need to know only the total production cost.
Correct.
Estimate of total production cost and not the total cost.
Correct.
Okay, understood.
Perfect. Nikki, you had a question?
Yeah, sir, sorry. Here you written OAR 2 per unit, where it is come from?
30,000 cost divided by 15,000 units.
Okay. And what about this one? Fixed non-production cost?
We did that as
Is
2,500 again divided by 15,000.
okay.
Yeah.
Mhm.
Okay. So in our P&L statement, we always start with our revenue. So how many units did I sell in this particular month?
14,000.
14,000.
And each unit was sold for how much?
$50.
$50.
So my revenue must be 14,000 into 50. Now I'll prepare my cost of sales. Did I have any opening inventory?
No.
No. How much did I produce this month?
16,000.
So I produced 16,000. Each unit needs to be valued at what number?
29. 31.
31. Okay, production cost. All right. So 16,000 multiplied by 31 is my production cost. But is this a fair comparison right now?
No.
No. I need to remove closing inventory. How much was I not able to sell?
2,000.
2,000.
And if you remember your accounts, inventory is always valued at the lower of cost or NRP, simply at cost. So that's what we do. Zoeb, you had any question?
No, sir.
Perfect. So our cost of production is nothing but 4,34,000, which gives us our gross profit of 2,66,000. Sorry for that. Yep. All right. Proceeding with the question then, let's deal with what we've learned, our non-production costs. So non-production mein, there's a fixed non-production cost of 2,500. So that's the directly deducted here. Correct. And there's a variable non-production cost of $1 per unit. So now what do I multiply it with, guys? Any idea? 1 into 15, 16, 14, which one?
14,000.
Why 14,000?
That's the units we are selling.
We are able to sell.
When it's a non-production cost, it's not related to production. Think of it like a carry bag. A carry bag will only be given for the number of units sold, right? So 14,000 into 1, our non-production cost is as follows. All right. Now the last adjustment to complete the question is we reached our month end and we saw that array, yeah, our actual fixed production cost was only 27,000. Actual fixed overhead was 27,000. How much, and think over it, how much do you think we have absorbed?
3,000.
30 is a fair shout, but think over it. 30 is not the answer. Chalo, I'll tell you all that. Think over how much we have absorbed.
28,000.
How much, Uma?
28,000.
38.
32.
32,000.
32. So think about it very simply. How many units did we produce? 16,000. Harek may we included this $2. Correct? So we ended up absorbing 32,000. Now, if I put it in plain English, it means I kept aside 32,000 for an expense, and at the end, I only actually ended up having to pay 27,000. So, is it a good thing for me or a bad thing for me?
Good thing.
Good thing in the books of absorption costing is known as over absorption. I over absorbed, I over prepared for an expense. I kept 32,000, I only had to pay 27,000. So how much will I earn back?
5,000.
5,000. So my over absorption, something that I had previously deducted in my this account, I will now add it back. I return that 5,000 in my cash, which I had prepared for my initial expense. So 5,000 ka income gets added back. If it was under absorption, which means my actual overhead was more than what I thought I will have to pay, then I would have to deduct it as additional payment to be made. Fair enough, guys. Take a moment, glance it over. That's it. That's the question done. Take a moment, please have a look at it.
Sir, that 32,000, can you explain it?
Sure.
So,
Yes, Sheila.
will you be sharing this Excel sheets?
I'll be uploading it on the LMS.
Okay, thank you.
Yes, Zoe.
Sir, I have a doubt in valuation of inventory. As you said, we valued inventory at full production cost. So,
Total production cost.
Total production cost. So, do we take fixed overhead?
We did not. That's what gave us 31.
Yes. So we
Correct.
Yes. So can't we take 29?
That's another method. That's what we'll learn next. Absorption costing is to get a more accurate idea of per unit costs. So we take it, so we include fixed production. Next method that we'll discuss, marginal costing, usme we ignore it. So we'll come to that. Okay.
Okay, got it.
Perfect. So to answer, I think, so to answer this question, simply, I have produced 16,000 units. Each of them I have valued at 31, which included 2 per unit. So if I separate that, 16,000 units or 2 rupees fixed cost has been included as my fixed overhead. So in this 496, 32,000 represents fixed cost. Actually, it was 27, so we got this answer. Fair enough?
Sir, I have a doubt. We took 16,000 for 31, but we also deducted inventory of 2,000 for 31. So shouldn't we take 14,000 into 28,000 as absorbed overhead? Because we already deducted closing inventory.
This is a deduction for inventory movements. ये next month opening भी बनेगा ना? So would you like to do that tricky math every month के last time का इतना, this time का इतना, or do you want to keep it clean?
But it won't be fair enough. Like it won't give a true and fair position now.
It does, because you are also deducting it from your closing, right? But you're closing your fixed overheads month on month. Fair enough?
I didn't understand. Sorry. Please repeat.
You are producing 16,000 units. In the month you paid this 27,000 rent for. Is that a fact?
Yes.
Correct? So your rent is paid in a month and you use that month to make 16,000 units. So why would you take inventory in that picture? What you couldn't sell is a sale related problem. Overhead is for production. You're paying 20,000, 27,000 a month for your factory. You made 16,000 units that month. Got it?
We have already deducted 4,000 for as a closing inventory. Na? Matlab 2,000 into 2 we have already deducted. So why we are adding back?
We are not deducting it from our profits. We are moving it to next month. Correct? But to move it to next month, you still need a full picture, right?
Yes.
So next month, you don't want to be in a position where you see, okay, these 2,000 units from last month, and then you don't want to go into that whole inventory math. That's what you learned in MA, in FIFO, LIFO, average method of inventory movements, right?
Okay. Means we will show a net profit of 254500, and then on the balance sheet closing inventory would still be valued at 62,000
Correct.
for that particular period.
Correct.
Okay. Understood.
Okay.
Thank you, sir. Yes.
Perfect. Any questions? Yes, Balvishwanathan.
Sir, I have a small doubt on total production cost, sir.
Go on.
After the total production cost, why there is no impact on variable non-production cost and as fixed non-production cost?
Good one. Our goal is to include every cost. Production cost has been included here. Do you agree? 31
yes, sir.
is included here, correct? So everything with tab tak has been included.
Yes, sir.
Non-production cost has been included here.
Okay, sir.
Everything has been included. It's just a structured way of showing it, so that production related costs are shown together, non-production costs are shown together. Okay?
Okay. Okay, sir. Thank you.
Perfect. So that's why in the start I said, okay, if you don't make this also, it's fine. If you want to show it also, it's fine, but it won't have an impact on your P&L. Any questions, guys?
No,
So,
sir.
perfect. So of course, some of you might be wondering, okay, yaar, this over absorption, under absorption, why? Why do I even use this approach when I can do something much more simpler? And that much more simpler thing is another method that we call marginal costing. Now, marginal costing comes in and says, boss, ye over absorption, under absorption is not my cup of tea. I will ignore it. You tell me when is fixed cost payable, fixed cost is payable at the end. I will directly include it at the end. As simple as that. Let me repeat by saying it once more. What marginal costing does is it introduces a new term called as contribution. Contribution is nothing but sales minus variable cost, which gives us contribution, and contribution minus fixed cost gives us. So what marginal costing tells us is, okay, why go into the hassle of forcing a fixed cost to look like a variable cost when it is clearly not? Why not just directly deduct your fixed cost at the end to arrive at profit? And so a term in the middle gets introduced called as contribution. Contribution as a name means how much from your sales did you collect to contribute towards the recovery of fixed cost. And that's again a new chapter, chapter number 5. Yesterday we discussed cost, volume, profit analysis, which is going to go much more deep into this, what we are learning. Today we won't go that deep, but for now, just understand what contribution means and how it splits costs into variable and fixed cost simply. Correct? This is the basis for break-even analysis, margin of safety, and much more that we're going to learn in chapter 5 sometime in the future. All right. Everyone clear with the term contribution?
Sir, so is there any differentiation between industries or the companies which use absorption costing or the marginal costing, or it's just the personal judgment what they want to use it?
So now though it's neither. These companies that use Tally, SAP, Oracle, all these softwares, they can generate profit as marginal profit and absorption profit both. Because data, like who's saying you only have to prepare it in one way?
But
Correct?
generally, like we have saw in Shark Tank and all, they generally ask for contribution, CPU, contribution per unit. Because for the startups, they are generally interested in CPU more than profit.
Correct. Because the reason is this is the part that scales. Companies say, for example, once I've built a software, my cost of operating that software will generally remain the same. But the number of people my software will cater to will only increase. So when a company is young, you're more interested in the contribution because you know that Filal, if this contribution is for 1,000 people, tomorrow at 1 crore people, it has a potential to earn money at relatively similar levels of fixed cost. That's why they are introduced in contribution and not profit. Because in early years, usually they make losses. But that is not a good idea to understand and gauge any particular business. All right.
Yes, thank
Sir,
you.
in marginal costing, non-production cost is not considered, or
It is considered. We'll solve a question. You'll see. Here we're talking about a way it's looked in. So let's do a question so you'll also understand how it's considered. Okay.
okay, yeah.
So it's the same exact question done both ways. So you all get that idea. Because this is a revision, we don't really need to practice a lot of questions on this. We just need to revise this topic. PM picks up from here. So these are fundamentals that we're getting on the same page. So let's prepare a cost card for illustration 2. All right. So in marginal costing, guys, only difference that we're going to do is we're going to be like fixed cost. I will deal with you later. So for now, in my cost card, do I still include direct materials, guys? Direct material is still part of my cost card.
Yes, sir.
Yes, sir.
Yes, sir.
The FISA. Direct labor is still part.
Yes, sir.
2 FISA. Other expenses, variable production overhead is still part. 4 per unit. This is where I stop. I will now say that this 29 represents my variable production cost. Okay. You see here in our cost card, we had a variable production cost and we had a total production cost. All right. So our cost card is done. Let's go ahead and prepare our P&L statement and just see how easy it is in marginal costing. So does my revenue change in this question?
No.
Still 14,000 into 50. Let's move to our cost of sales. I will still have no opening inventory, sorry. I have production of how many units?
16,000.
16,000 units produced at a cost of what per unit?
29.
29.
That's the only difference. So let's deduct our closing inventory as 2,000 units unsold also at 29. So 16,000 multiplied by 29, and 2000 multiplied by 29 as a negative, and our cost of sales is 4,06,000, which gives me my gross profit 2,94,000. Any questions? All I've done is instead of 31, I've taken it at variable production cost.
That this gross profit is the contribution, right?
Yes.
Yes, correct. Here you call it contribution. Okay. Yes, Zoe.
Sir, the valuation of inventory changes as the method changes.
Yes,
In marginal, we don't use full production cost, right?
correct.
Okay, sir, got it.
Yeah, and I'll show you how that is also addressed later on. Let's finish the question.
Yes.
So now all I need to do, guys, is deduct my full fixed cost. So what should be the figure I take here?
27,000.
27,000 actual.
27,000. So directly, all I need to do is this. Non-production fixed cost will also come, and non-production variable cost will come. So non-production fixed cost is 2,500 and variable cost is 14,000, which is 1 into 14,000. So I have my profit now, which is nothing but 2,50,005. So before we discuss why the profits are different and all these things, let me ask you all if you all are clear with how we deal with fixed overheads in a marginal costing setup. Any questions? I hope everyone's with me. A yes or no, please.
Yes, sir.
Yes, sir.
Perfect. I didn't hear 80 yeses, but okay. Let's proceed for now. Let's check how many of you all have. So 10 or 12 of you all are giving me company with videos on. Baki others are chilling. I hope people are not in a Sunday mood. Okay, Kushbu has joined. All right. Okay. So surely you all have one question still. Key, why are the profits different? And if the profit using absorption costing is more, is that any indication of this method should be used or something like that? So let me answer that first of all. Okay, this is purely a valuation difference. It's not that my profits are more. It's simply my closing inventory. So the 2 rupees ka difference, $2 ka difference is justifying my profits. My closing inventory of 2,000 and my fixed production overhead of 2 give me my profit difference. So this $4,000 which I see are different in my profits are only because my inventory, closing inventory is valued at 29 year versus it is valued at 31 year. So that 2 ka extra deduction that I did, which ended up not being part of my cost, gave absorption costing a higher profit. But this is only one of. In a month where opening inventory is higher and closing is lower, it can also flip. All right. And again, those kind of questions were tested at an MA level. At a PM level, this is not something that they go into because you've already done it in the past. All right. But the difference in profits is simply an inventory valuation difference. Not that we want more or less money by having 1 or 2 methods of accounting. Everyone clear with that?
Yes, sir.
So that's our marginal cost in a nutshell. And yeah, I think so. This will be gross profit only, my bad. Because we had this variable cost here also, na? And like I told you, all variable costs need to be deducted to come to contribution. So there's just one small thing. If you want to calculate contribution, like they've done it in the textbook. You have to deduct the variable non-production cost also. Sales minus all variable costs give me contribution. All right.
Yes.
Okay. All right. So one last small topic, nothing to calculate. Let's quickly do this topic for 10 minutes and then we'll take a break. Fair enough, guys?
Yes, sir.
All right. So my last question before the break goes to y'all. If costing is a method that we follow, say for example, I do this every month, Jan, Feb, March. Let's say 1 month my cost is 32, next month my cost is 30, 24 aa gaya. 34, another month my cost is 30. And let's say I want a simple 20% profit. I'm not very greedy. I want to earn 20% profit. Can my selling price in the open market keep changing depending on my mood?
No, sir.
There needs to be some consistency in your selling prices in the market, right?
Yeah.
Correct. But your costs will genuinely not be consistent every month, because every month there are inefficiencies, there are price rises, there are things always happening which affect your cost. Correct. So for this reason, what companies do is they prepare what we know as a standard cost card. Okay, if things are going well in a particular month, what should be my cost? Say, for example, in a good month, my standard cost card is 28. Depending on that, I will set my selling price, chalo, let's say 34. And that, guys, is the price I charge in the market. Then it all happens on the background, where it's the production manager's responsibility to ensure that they meet the cost card in every month. And when they don't, is where they get what we call as variances. So in chapter 15, when we learn variances, we'll be going much more deeper into this. For now, we just need to understand why a cost card needs to be a standard nature, so that all these differences are handled at background rather than, of course, for a customer. And we need to understand what kinds of standards exist. All right. Everyone understood the need of a standard cost card?
Sir, can you please explain it again? I lost my connection.
Sure. So I was just saying, okay, every month, due to changes in material prices, labor availability, sometimes there is a strike, sometimes production, like machines go broken or something like that, costs keep moving up and down. But I can't have that in my market, as my selling price cannot move. So I look at an ideal scenario and prepare a standard cost card, and basis that I make my pricing decision. Then it is the responsibility of my manager every month to compare against the cost card and see whether he's doing good or bad. But all that is something I handle at background rather than foreground with the customer. Fair enough?
Yeah, okay, understood.
Perfect. So what kind of cost cards exist? The very first one is a basic standard, which is basically the very first standard that you make, a long-term unchanged standard that you make to get you into the standard costing system. You always try and make a perfect standard. Perfect operating conditions is known as ideal standard. This, guys, represents perfect conditions. None of your employees get unwell, they don't need breaks for weddings, they're always available, your machines will never break down, your material will always be available, no processes will get overheat, demand will not be a problem. When everything is in a perfect state is when we call it an ideal standard. And of course, it's a myth. 10 on 10 is always a myth, correct? So you will always have a standard which you currently operate in, correct? Which is based on the current levels of production efficiency, right? So that's what you're able to do today. Now, of course, the goal of every company is to keep improving. Like I told you today, only two ways to make money: increase revenue or decrease cost. So I want to keep tracking whether I'm able to grow and keep reducing my costs, correct? But today, if my current cost is, let's say, 32 and my ideal cost is 22, and I tell my manager, okay, bhai, anyhow, you will have to reduce the cost by 10 rupees. My manager will get afraid. How do I do this? So you bridge the gap with the help of simply attainable standards. You want to keep giving challenging, motivating targets to your manager with the help of attainable standards. The idea is that today I will give my manager कि यार 32 say try and get us to 30. When he reaches 30, 30 becomes my new current standard, and now we give him a new attainable target of 28. धीरे धीरे करके we try and get incremental gains rather than giving a very challenging target, the manager losing motivation and not even trying. So attainable standards bridge the gap between ideal standards and current standards. So the company is constantly in a journey of improving their cost cards. Make sense, guys?
Yes,
sir.
Here, as you see, levels at which production can reach over time. Okay, so you want to keep improving over time to reach your ideal, but 10 on 10 is a myth. You will never have a month when everything goes perfect. So you just want to get as close to it as possible to keep reinventing what you thought was not possible. All right, that is cost cards in a nutshell. Roshan, basic is nothing. Basic is, as the name says, the very first cost card that you would make, just to give you a basic idea. Okay, these are my costs. That is an activity done to give you an understanding okay, what all costs are actually going to be incurred. So it's a simple, basic first cost card that you make. Like even the name says, their use is fairly limited and they're the least useful type of standard. Okay, so it's just a track record that you start with. The starting point is your basic standard. Okay. Any questions with cost cards, guys?
Sir,
Yes, Arvind.
sir, if the cost is now is 32, but we have to reduce it to 22, right? So the 22, is that the attainable standard?
Ideal.
Ideal. Okay.
Attainable, for example, you can set to be 30. So that the
30.
challenge is only limited.
Okay. So what is current then?
Current is 32. Current is what you currently are at.
Oh, currently are at. Okay, okay, okay.
Yeah.
Thank you.
Perfect. No worries.
So,
Is everyone clear?
So, who sets the ideal standard? Like ideal standard
One
is
second, a network got lost. Can you?
so who sets the ideal standard of anything, like any cost?
The same managers. The idea is कि अगर everything goes perfect, what's the best cost that we achieve? The objective of doing that is to see कि whether there is even room for improvement. And that's usually. Okay.
Yeah, thank you.
Yes, well.
Yes, sir. So basically, we are playing around the cost card, right? So cost of product.
Like standards can be for anything, but in this context, we are talking about cost cards.
Okay, okay.
Parul is asking, attainable standards are normally better than the rest and should be followed. Yes, you're always striving to close the gap between current standards and attainable standards. So you're always on the lookout for ideas to do, like even as a teacher, every batch I strive to do one better thing than what I did last time. I can't be like, "Hey, this time I'll do something completely different and either ruin the teaching for y'all and also for myself." So attainable approach, incremental approach is generally followed everywhere. You want to keep getting 5% better every time rather than trying to change everything and messing it all up. That's the simple idea of attainable standards. Continuous improvement, correct. All right. Perfect. So with that, we're done with our revision chapter, chapter 0. Let's take a break. We'll come back and we'll move into one of the simpler chapters today, target costing, after our break. All right. Let's resume class at 4 p.m. in 20 minutes. Sounds fair, guys?
Yes, sir.
Yes, sir.
All right. See you then. Thank you, guys.
Thank you.
Move everyone back. You share my screen until then. Right. Everyone back? Yes or no, please? Then we can begin.
Yes.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
All right. Okay then. So guys, today we'll be jumping a little bit. Now that we're done with our revision chapter, we'll be doing chapter 2, target costing first, right? And the premise of target costing is also very, very simple. Like, let's continue what we were discussing for cost card. And let's say, for example, take another product. Let's say, for example, I want to manufacture PM biscuits. I'll convince 5 of you to join me in this venture. We'll all do this together and we can make a biscuit company. Let's say I do my standard cost card. I include labor, material, I include variable, I say I'll include fixed overhead also. And I come to a production cost. Say if I take dummy numbers, maybe material will be 8 rupees, labor will be something like 5 rupees, maybe variable production overhead another 6 rupees, maybe fixed production overhead another 8 rupees. It's going to be 5. So I will get a production cost for my business. And chalo, again, 30% margin, decent enough margin for us to do a venture. So I'll take 30% markup and I'll come to a selling price per packet of my biscuit, which will come to something like 31.2. All right.
Yes,
Of
sir.
course, I won't sell in the market for a decimal. So maybe I set my selling price in the market as 32 rupees. Yeah, someone was saying something? All right. So just for a quick question, what is the price of Oreo biscuit in their mid-size, normal size packet?
10 rupees.
10 rupees.
The starter one is 10, and what's the other price for the larger pack?
20, 30.
20, 30.
35. 35.
Yeah, 30, 35, whatever. Let's take 30. So my example stands. So simply put, if you are in the market buying biscuits, which is a heavily commoditized market, and I've made a similar quality biscuits in my brand, of course, as a consumer, as a price sensitive consumer, would you as easily be willing to try this new relative biscuit, which is more expensive than a common household brand, or would you stick to your common household brand?
Stick to
I'll
common.
choose
To
Oreo.
household.
Stick to this. So our cost plus pricing, the method that we did to arrive at a selling price for our product, often does not hold true for majority of businesses. Cost plus pricing as a method is suitable when the nature of your business is heavily differentiated, when there is no way to compare what you are offering versus what someone else is offering. But in this digital age where it's very easy to pull up an internet search and compare prices of competitive products or your general understanding of competitive products, often you would make a price sensitive choice and you would need to price accordingly. A very common phenomenon in India is the 10 rupee phenomenon that you all said. In India, for a lot of things, there's a 10 and 20 rupee problem. So let's take soft drinks, let's take biscuits, and there was also, I think, things like Lay's and Kurkure and all these things. So chips. In India, since years, if you're noticing, the prices of these things are not going more than 20. In response, the companies are only able to reduce quantity of the products and not increase the price. Because for some reason, as an Indian consumer, we have associated the value of 20 rupees as enough value to get that particular packet of chips, that basic biscuit packet, or that soft drink ka chota bottle. So these kind of problems where the market and the nature of the product has already devised a selling price, companies often have to do clever things to work around it rather than, try and be like, "Nahi, nahi, I will sell at a higher price. Whoever wants to buy will buy. The product will fail and then you'll be wondering what went wrong." So it's often very important to understand the market driving forces of your product and use that to set up a selling price, set up a product price, rather than be like, whatever my cost is, I will add a markup and I will come to a selling price. When you become aware of this, when you become conscious of this, you follow something known as target costing principles. Target costing is very, very simple. I'm sure some of you have already pieced it together. It's basically a reverse form of pricing. Here we simply say, okay, boss, target selling price. What is your target selling price? I will say in my case of biscuits, my target selling price is 30. Okay, say I'm making a comparable product. So my target selling price is 30. And I still desire to make a 30% markup. So that's my target profit. And I will have something called as a target cost. So my target profit is 30% markup. We've already learned this. Can you guys tell me the target cost? Can I incorporate markup in the selling price and tell me the cost in chat?
Uh, 23.
I'm getting a lot of 21s. I'll also check. I don't think.
Markup 23.076 profit.
Just a second.
Cost, sorry. 23.
3.08.
So 21 is wrong. That much I can tell you. Whoever's saying 23, that seems correct. So and that's what I said in the first half of the session. Margin markup is a very silly topic, but it's a trap. So unless and until you're very conscious about it, odds are that you will be confident, but you'll be confidently wrong. All right. So just to be clear for everyone, again, always build a case. Markup is on what, guys? Selling price or cost?
Cost.
Selling price.
Markup is on cost.
Oh, sorry.
So selling price becomes 130. Using this, I can now do my calculations. So 100 divided by 130. Sorry, it will be ulta. Yeah. 130 divided by 100.
100 into 30.
Into, not wait. Yeah, always go with your gut feeling. So target cost comes to be 23. You can say it's okay. This is an example. And my target profit is 7. If you want to cross check, 30% on 23 should be 30. All right. 21 for all those who got it, that was 30% margin and not 30% markup. Remember, the company wanted to earn a 30% markup. We just respected that choice by allowing for that calculation. So under target costing, that is all we do. We first research in the market and we find out a target selling price. Then we see what is the target profit the company wishes to earn. And respecting that, we arrive at what we call as our target cost. Any questions so far? Okay, everyone with me? Anyone who joined late? Any confusion? Okay. Yeah.
First, we are setting the selling price and then the profit.
Yes, we are not setting the selling price. We are agreeing to the market selling price. So we are researching and finding what the market will be willing to pay for a product we are able to sell. And then we are back working.
Okay.
So currently, guys, let me copy this here. And let's say this is 24. So 1 second. Yeah. If you only focus on this much, I need my cost to be 23, but my cost currently is 24. This is where we call there exists a cost gap. Cost gap exists when the production cost or the budgeted cost, let me write it that way, is more than the target cost. So what is my cost gap here, guys?
1.
24 minus 23.
My cost gap is 1. So if I am to meet the market's requirements, I will have to go back to my drawing board. I'll have to go back to my budgets and find a way to reduce my cost by 1 for me to be able to earn the desired profits and sell the suitable market price so that, of course, I don't fail in terms of a pricing strategy also. So my goal then becomes to find ways to reduce this cost gap. This whole process simply is known as target costing. Correct? Everyone clear of the steps that we followed?
Yes.
Yes, sir.
You can see it here as well. The very first thing that I do is determine my selling price. I determine my market price to be 30. I decided my profit margin, which was 30% markup. And then I calculated my target cost. Sorry for that. And then, of course, I went forward to estimate my current selling price. I found out my cost gap of 1. And my last step is to try and close the cost gap. All right. Can anyone think over this and tell me why is it important to do steps 1, 2, 3 before we do steps 4? Any idea? Think over it. I've not explained it. So you all have to think on why is this set up the way it is.
So that we can find out the
Like before
actual cost.
producing any goods, we decide the price, selling price.
Actually, before selling, before
One second.
producing a good,
If you all can raise your hand. So I think Rahul was saying first. Rahul, go on.
So that we can find out the cost and compare with actual that cost us and fix it.
But that's my point. The cost we can find out of B also. Why are we doing it in this order? Do you all agree that these two are unrelated? Market cost and my cost. I can find out both of them. So why is there an order? Why are we finding market first and then internal?
If we won't find market first, then like how do we know that like how much to reduce the cost or increase the cost?
Reducing cost is step 5. Huh? Estimating the current cost can be done. So okay, let's have others also try. Yeah, Khushbu. You're muted.
Because
Yeah.
we have to decide the selling price first. and then we have to estimate the cost, and it's just an estimate. That first, second, and third is the planning step. Fourth is just an estimate.
Okay, not really. Selling price is what, like, again, my question is, I can do this activity after step 4 also. So why are we doing this activity first?
Calculate the cost.
Sir, because that price is before selling price, and after the steps is after selling products values.
My selling price gives me my target cost. My own calculations internally give me my current cost. I am questioning order of.
So that's the benchmark we need to set for.
Okay, wait. Umang wants to
my-
go next.
Sir, actually, as the class started, we decided that the main objective of business is to earn profit. So first of all, we need to see that how much the industry is selling at what price, and how much profit do we need from that product. So we need to find out the target cost and the selling price, so that we can assume our profit. And after that, we need to estimate our cost and find the cost gap to reduce that.
Okay, partially you're doing that. I'll clarify. Okay, take it. Yes, Kashish.
So that's the benchmark we set for the cost we need to acquire. For comparison, that if the direct material is $8, then my direct material should be less than $8, or should be equal to $8 to get a $30 selling price.
So again, very close, partially right with the word benchmarking. But will Oreo tell you what's its direct material cost? Will they tell you anyhow?
No,
But you're right. Benchmarking, you're close again. Yeah, Zoe.
So we are competing with the competitors. So first we decide the selling price according to them, like in line with the other selling price. Then we decide our profit, how much profit we can generate by producing in line with the selling price.
Right now, so again, you're all closing in. The simple explanation behind this is feature mapping. If I don't see what is the product I'm comparing with, my cost will be inaccurate. Say, for example, I make a cost card first of 1 kilo packet of biscuits. And then in market, I understand that, okay, 250 grams is the ideal packaging size. I will have to repeat this activity anyway. So I first go out in the market and do feature mapping. Okay, this quality biscuit, this cream biscuit, this particular target segment of a biscuit, this size of a biscuit is what I want to sell. Then I go ahead and make my cost. Okay, if I'm to make the same thing or similar thing, my own unique, but the same comparable features, what is the cost to make that? That's why you do your own costing afterwards. Remember, it's an unsaid rule in performance management. The external activity has to happen before the internal activity, because the internal activity is in your control. The external activity is not. Remember, it is not as easy as we are making it. We are just taking random numbers, but companies have to do a lot of work to come at an internal cost card also. So it's beneficial that they only do this activity when they already have market info and they know, okay, now the moment I compare it, all my changes can keep going in a logical manner. But if I first make a cost card, then go out in the market and then do a lot of learnings and then again rework my cost card, I'm just wasting a step. Making sense?
Yes, sir. Basically, initially we have to first analyze the competitive products.
Correct. First you learn, first you benchmark, then you see, okay, what will be my cost for the same thing here, rather than what will be my cost for something, and then going in the market to see what that something is. Okay. Anyway, it's not connected as much, but you need to understand why the order of steps is also important. All right.
Can we say it's a kind of first market research before we start our activities?
Correct. Simply the answer is that I'm just going into why that's the case. Okay.
And one more thing, sir, if my product is creating a moat in the market, then I can set any price according to my profit margin or something, or I have to do some any other type of research for that price fixing.
You're saying if your what is more than the market?
I'm saying my product is creating a kind of creating a monopoly like Maggie.
Correct. So then you're a price setter and not the price taker. But most probably in businesses, it's a very rare opportunity where you get to be the price setter. In that case, of course, your whole research is completely different. Then you do a top-down research. Okay, what's my target audience? What is their income? How much are they willing to spend? That's a completely different topic. Okay. When you're a price taker, that's when target costing helps. Okay.
Yeah, because in this case of Maggie is also won't be able to increase the price of a 10 rupee packet to 12 rupees. They they need to use shrinkflation.
That's what the example that I gave you all was of shrinkflation. Okay, 20 and 10 May India is not moving on only, even though years of inflation has happened. So companies they do shrinkflation where they reduce the quantity rather than increase the price. So again, a completely different topic, but more interesting. Okay. So let's do a quick activity. Production cost, target cost, cost gap. So let's say my production cost came to be 95 and my target cost came to be 76. What should be my cost gap?
19.
19.
19. Everyone in agreement?
Yes.
Say my production cost was 123 and my target cost is 152. What should be my cost gap?
Minus 29.
Zero.
Negative 29.
Minus
Minus
29.
29.
29.
Okay, minus 29.
Yes.
So one more thing we need to learn and remember is that a cost gap only exists when the target cost, or like I said, when the budgeted cost is more than the target cost. If there is no gap to close, essentially it is zero. Please remember that you're already below the target cost. You can come up with the selling price, which is the market selling price, and you can simply enjoy a greater margin. Enjoy. But there is no cost gap here. So one thing we resort to sometimes is we just find out the difference between both and we give that as the answer. But please remember, cost gap only exists when the production cost is more than the target cost, not when the target cost is more than the production cost. Okay, because there is no gap to close already. Everyone clear with this?
Yes, sir.
Yes, sir.
Okay. So yeah, some of you all have given me zero in the answer. So yeah, if you all got it before only, perfect. But everyone hopefully is on the same page now. All right. So here's a quick discussion on how do we do step 6. What are the things that we can do to reduce or close the cost gap? Because no one's saying कि यार cost gap है तो don't enter this business. Someone is able to achieve that, right? Our competitors are able to come to the market with that price and they are also making money. So what's stopping us to make money? Just our ideas. We need to figure out what is to be done to meet the market's expectations. So, Junaid, do you mind reading this point by point?
Okay, sir. Let's reconsider the design of the project. We should look for any possible changes which can be made to reduce the use of any element. Also, eliminating any extra process will reduce the cost.
So here it's a simple case of because you have not committed to the production of your new product. Try and go back and find ways to reduce the processes involved because lesser processes will mean lesser cost. Try and see if you can do with lesser material. Maybe you waste less material. Maybe you find a way where your material gets, if you're say a drinking product or something, maybe there's less evaporation or wastage or profluorage. So all these things can be done before you commit to production. Once a production unit is set up, it's too late. You have to rework everything, it will be very costly. But if before you commit to it, you can always figure out what is more efficient ways to do it when you know there's an incentive to do it cheaper. So reconsider the design is very important. Yeah. Yeah. Second one.
Source similar quality materials but cheaper from another supplier if available.
That's simply the benefits of outsourcing. Maybe if I make my own display in a mobile phone, I'll find it very expensive. But if I just buy a display from someone who makes displays, I'll get it for cheaper, even if they add their profit margin. Because they are doing it at such bulk, such economies of scale. Okay, for me, it's good to have a good quality product, but at a cheaper price. So I can always do these kind of things to also meet my targets. Point 3.
Try to remove features or elements which are not valued by customers. For example, a metallic body for a pen may not be valued by customers when they can get a lighter plastic body. Care must be taken that the selling price of the product does not fall due to this.
So this line is important. Now, this India saw when these companies like MG in cars came up with their first model where they introduced heated seats and all these kind of things. And they immediately realized that in the Indian customer value segment, people didn't care. People didn't want to pay for it. But because of them putting that feature, they had to amp up the selling price by a few lakhs. And that took them out of the pricing segment. Correct? So companies have to do something called as value analysis, where they interact with their target customer. You see this when you shop in the older way, when you shop in DMarts and all, where there are live stations of new products, where they just offer you the product to try the product. Their intention is not to sell you the product then. The intention is to get your feedback. Do you think it's value for money? Do you think is there any feature that we've put but you don't need and you don't want to pay for? Those kind of inputs help the company shape the final product, which may not have some of the features, which would have only benefited a few customers, but not all. So value analysis is important, but you need to ensure that it doesn't take you in a different bracket only. Is it fair for me to compare apples to oranges? No. So when you're doing target costing, you need to compare similar products. So when you eliminate features, it should not be so, okay, now you're a completely different product only. Correct? You just need to remove the features that are not valuable in the eyes of a customer. Fair enough, guys?
Yes, sir.
Okay. Yeah.
So cost can be reduced by reducing wastage of materials and idle time of employees.
Perfect. I think fairly self-explanatory. You reduce wastage, which means more output, and you reduce idle time, which means more productivity. All right.
So we can achieve cost reduction through economies of scale by increasing the level of production. Use of machines can help to reduce production cost.
Right. See, read the 6th.
Okay. Some parts of production can be outsourced to external parties who can give similar quality at a reduced price due to better experience.
Perfect. Both the things that we essentially discussed, either you do economies of scale or you outsource, because scale is not possible for everyone immediately. So then you do outsource, even then it will be cheaper for you. Correct? So as simple as that, and you try and close your cost gap. The two things that you cannot do, which fundamentally breaks the logic of target costing, is cannot adjust selling price to reduce cost gap, of course, because that's the whole basis of the system. Cannot settle for lower desired margins, as the companies have also their maths behind everything. In financial management, those who have learned it, there are reasons behind the company's demanded price, because they themselves have cost of capital, they have their own calculations. So you can't simply go and say, okay, yeah, settle for a lower margin, so our product is more doable. Correct? That's not the answer. Answer needs to be in the cost itself, not in the markup, not in the selling price. Okay? Yes, Umang is asking if selling price reduces, then can I apply target costing? Of course not. Because if this reduces, you're of course going into a different target product only. So then you have to compare it accordingly. If you're staying in the same target product, then the selling price will not change. Okay. Let's come back to all this. Let's practice one more question before you all. Okay, let's do these two questions, then we'll cover the rest of the book. So, question one, which of the following statements are true? Target costing is a guarantee that company will make desired profits. Is this true or false?
False.
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 False, because we are incorporating a profit.
But it
Anyone
doesn't
can
guarantee.
justify?
It can assure us, but it cannot give us guarantee that we make profit.
Perfect. The word guarantee is a red flag. You cannot guarantee because all we are doing is essentially doing forecasts. We don't know what reality will be. So nothing, no method can guarantee something. It's as simple as that. All right.
Yeah.
Second point, target costing is a market driven approach. True or false?
True.
True. First we analyze the market.
Correct. Market driven approach, which is what we did. Find out what the market can offer and then you do your basis. So B is the right answer. Question 2 is a question like we just did. I'll read the question, you all try and solve the question, then we'll solve it together. Okay. Selling price of a product is $2,000, external selling price. The producer requires a margin of 40% and they have given their own costs. So you can calculate your production cost, you can find out a target cost, and you can answer the question, what is the cost cap? Now the answer is there at the bottom. If you have access to the book, try and not see it and do it by yourself. If you can't, we'll solve it together afterwards. That's correct. Etiksha, Dipanshu, correct? Yeah, I think everyone's getting it. Take a moment, we don't have a rush. Try and solve it for yourself. Anyone stuck, confused with how to go about with this? Feel free to ask. All right, I think everyone has it. Answer is D, 250. And very simply, I'll just write it for anyone who wants to. So, step one, target selling price, 2000. Desired profit, 40% margin. So, selling price needs to be 100, cost needs to be 60. So, target cost, again, you all can do it your way, 2,000 into 60%. 1200. And my production cost is a total. So 550 plus 750 plus 150. 1450. Since production cost is more than my target cost, my cost gap of 250 exists. Any questions, guys? That is practically the chapter. Now we just see 2-3 more nuances, 2-3 more different things, but that's it. That's the chapter.
One doubt.
Yeah, Uma.
Sir, should we take fixed cost also in production cost?
Yeah, you should. That's part of your cost gap, right? That's part that it's a cost that you're going to incur, right?
Okay.
Any other questions?
Sir, here the target cost means that we are taking it from the market. So the production cost is about the company.
Yes, yes.
Okay, sir.
All right, perfect. All right. So continuing with the discussion, target costing in service industries. Now, yesterday also I had mentioned that companies are product oriented. They sell a particular physical or a digital product, or they provide a service. Now, of course, this might be a revision again for a few of all, but service industries have it their own way because the nature of services is different from the nature of a product. They are different because of these following reasons. Like they are intangible. Services are not tangible. Like right now, I'm teaching to you, there's no tangible product involved. We are simply doing a case of learning. Correct? It cannot be seen, it cannot be touched. Services are perishable. Again, when you get a haircut, the service is perishable in nature. You are not, again, having any particular thing that you can store, you can take it away with you. It's being provided to you, which is essentially the third point, simultaneously. You consume a service while the service is being provided, whereas a product is used after it is being purchased. Correct? So services are simultaneous in nature. They are heterogeneous. For example, no two teachers teach in the same way. No two haircutters cut the same, like salon or whatever, cut your hair in the same way. So they are heterogeneous in nature. Whereas products, like I said, one of the things in target costing, comparable. But how do you compare services? How do you say, okay, this is clearly the same service, so the pricing also needs to be similar? Correct? And that's where we are also seeing the world is moving towards a service based economy. Because in a service is where a company has an opportunity to differentiate themselves. But if you only provide a product, your product becomes easily comparable, and then you enter into the trap of pricing strategies. Correct? And of course, since there is no physical asset, there is also no transfer of ownership. You only get to, use the facility or service provided. Correct? But does this make target costing impossible? Not really. You can follow a very, very similar process even in service based costing, but just your context slightly changes. So we took an example of biscuits. The book also gives us an example of service, which is Bharat Cleaners service of a cleaning services to corporate offices. Correct? So same exact thing of target costing can also be done here. But the only focal point changes is you try and map each and every service from the core features of the product. So say for example, their current system, currently their labor cost and material cost of 1 hour is $20 per hour. And they want to earn a profit of $10 per hour. So their cost becomes 30 per hour. But this cost plus pricing system can still affect them because they don't know the competitors. They don't know if they are cheaper, more expensive. Either way, they are at a loss. So they need to go further and do target costing analysis where they will find out the rates the clients are willing to pay, whether they are charging too much themselves, the pricing strategies of the competitors, because you don't want to lose business, and of course, cost control, because you want to constantly reduce your costs and improve your own margins. So if Bharat Cleaners were to use target costing for their service, again, it's the same exact steps. First, you try and establish a competitive market rate. You consider how much clients are willing to pay for similar services. Now, this is the part where judgment needs to be applied. You see services being provided at all scales. You'll see people providing salon services at 50 rupees a haircut. You see people providing at 250 rupees, you see people providing at 2500 rupees a haircut also. So you need to gauge what bracket do your services fall under and then try and find the comparable service, right? And then again, do the same thing. Deduct your required profit and you have a required target cost. Compare with the target cost, you have a cost gap, and then you take your steps to reduce the cost gap. So all the steps that we discussed remain the same even in a service, except the judgment of what you need to compare with. Because if you truly feel, I think someone said, right, okay, if I think my service is completely different, completely out of the box, then I may not be able to gauge a correct competitor. But I can still gauge, okay, what are competitors charging and what are the services they are offering. So I can at least understand, okay, for the additional services that I am offering, how much more can I charge? So at least I can justify my price, correct? So that analysis helps when I do target costing, even in a service industry. Remember, the core difference in a service is that a service sale is communicated. A product sale is not communicated. When you go forward to buy a biscuit, you pick a biscuit and that is it. The biscuit seller, the company, does not understand why you chose not to buy a biscuit, or they don't get a chance to defend why their biscuit is better and hence it's priced higher. But in a service, it is possible to draw in the consumer and explain why the value of their services is higher and still go forward and make a sale. That's why target costing in service industries slightly differs. All right. Any questions here?
But sir, when we sell a product, we can identify customer behavior, right?
Correct, but it's not possible, or let's say it's not as easy as that for services, right?
Yeah, we can argue on that. Yeah.
Correct. And here, don't take the example of a haircut because you still have to enter the shop for it. Take an example of a larger service, such as, say, for example, the cleaner example. It's a contract, right, of a service. So I can go and pitch, okay, why my price is the good one, what all do I provide? I can justify. Can you do that with an expensive product? No.
No. Yeah.
It's all in the power of the consumer there. So that's why it's a different thing.
Okay, sir, got it.
Any questions, anyone? All right. So let's practice one more question, illustration 2. Very, very simple question again. Yeah, this is the question. All right. Right, long question. I'll copy it for us. That's right. Okay, so again, a very, very simple question. What are they asking of us? Compute the current cost of some of their products and compute the cost if they are revised. And how do this compare with target costs? So let's read the question. Let's understand the question first. IBM Limited manufactures and sells computer peripherals to several retail outlets throughout the country. Amar is the manager of the printer division. Its two largest selling printers are P1 and P2. The manufacturing cost of each printer is calculated using IBM's activity-based costing system, a chapter that we've not even learned, but we'll be able to do the question. And like I said, questions are always mixed in PM. All right, but nothing to worry for now. IBM has one direct manufacturing cost and 5 indirect manufacturing cost pools. All right. So basically, P1 and P2 may the cost of materials is given to us, and it uses a lot of parts and assembly and all these things. And the cost per part, per machine, per whatever is given to you. So all we need to do is multiply, 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 and we'll be able to come to a total cost of P1 and P2. That's our first requirement. Let the requirement go. First requirement is compute the current costs. So let's simply do that. Okay, so yeah. So let's take costs of P1 and P2 and let's prepare our standard cost term. So direct materials are given to me, which is 407.5 and 292.1. I've taken that from here. All right. Now all other costs are variable. If you see parts, how many parts does P1 use?
84 into 1.2.
And my cost per part is 1.2. So that's my cost of parts for P1. I need to do the same thing for all my costs. So I'll do that for P2. Then we have assembly hours. So again, 3.2 assembly hours and the cost is 40, as you can see here. And for my second product, 46, sorry, 1.9 into 40. Similarly, I'll keep doing all of them. Machine parts, manual parts, and quality tests. So machine parts are 48 and cost is 0.7. 31 for P2, 0.7. So I'm just multiplying each of them with their respective figures. 15 into 2.1. Finally, 1.4 into 25 and 1.1 into. That's what allows me to get a total cost currently. Any questions so far?
No.
So my current cost for P1 is 780 and 504. Part A of the question is done. Let's move to part B. So let's read through the question further. A foreign competitor has introduced products very similar to P1 and P2. Given their selling prices, to maintain the company's market share and profits, Amar estimated P1 to have a manufacturing cost of 680 and manufacturing cost of P2 to be 390. What is this, guys? 680 and 390?
Target cost.
Directly given as target cost.
Target cost.
He'll give you the selling price and ask you to calculate. He has calculated himself as these prices. So is there a cost gap currently, guys?
Yes. Yes.
Yes, sir.
What is the
100.5.
cost gap for P1?
100 point.
And what is the cost gap for P2?
114.
Perfect. So what has he done in response?
Need to reduce the price.
He called a meeting of the designers. They agreed to have 680 and 390 become target costs for the products. Now their designers found alternative ways to designing the printer comparable but at lower costs, and they came up with the revised designs. Correct? So let's make a new cost card. With our revised costs. So again, maybe I can just a moment. Yeah. Right. So the rate per part remains the same, but now the number of parts being used, they have ended up reducing. Okay. So what is my new material cost for P1?
381.2.
381.2 and 253.
3.1.
And now again, the same activity we'll quickly do. So now 71 parts at 1.2, 39 parts at 1.2. So slightly boring, but bear with me. Just need to carefully do it to avoid any mistakes. Please cross check with me. Machine will be 59 into 0.7
Yes.
and 29 into 0.6. Manual will be 12 into 2.1 and 10. 2.1. Then 1.2 into 25 and 0.9 into
25.
And before, guys, I go into the current cost and all that, you should also see what is it that they actually reduced. If you notice, biggest chunk of reduction happened in things like manually inserted parts, whereas automatically machine inserted parts went up. So whenever a company does this and reduces the cost gap, it's often a result of doing more automation, introducing more process oriented work, because labor oriented work tends to be more costly than machine oriented work. So whenever a company redesigns, it's often looking at these ways. That's why when I told you all yesterday that IT as a chapter is also very important, is because you need to, if you are not the person who finds these solutions, odds are that you're going to work with the people. You're going to be the one who tells the engineers that this is where you want to find a cost reduction, and then give them the task. Okay, whatever you need to do, you do. So you need to have an understanding enough to be able to be the person who commands in a business consulting what do you say position, correct? So that's why this is fairly important. But here, of course, the numbers are given to us. Let's just check if the target cost has been addressed or not. So these are our current costs. Our target costs remain the same. So what's the cost cap for P1 now?
0.
0.
0. I hope everyone's in agreement.
Yes. Yes, sir.
And what's the cost gap for P2 revised?
0.
47.
No, it's 7.
Correct. So if I am to conclude, by revising the production design for their printers, P1's cost has met its target cost. However, P2 it still has a cost cap of 47.7 rupees. So this had very little to do with finding the target cost. It was actually working the internal numbers. All right. Any questions here, guys? I hope the question was simple and manageable.
Yes, sir.
Is everyone with me? Any questions? Please feel free to ask. Please go through the question, see if you didn't understand anything.
Sir, this hours of assembly, how it is related to like assembly time, assembly time.
So I need to assemble my printer, right? So if it takes, where is it? Yeah, it takes me 3.2 hours to assemble my product. Each hour I have to pay 40 rupees for whoever's time.
Means it's a kind of direct labor time.
Yes,
है
you
ना?
can say.
Okay, understood. Thank you, sir.
Perfect.
So from exam point of view, how this question would be framed, like
So this though very rarely, such a question would rarely come. Questions would come of those MCQ. Target costing we already know will not be a section C question. It will be
Right.
an MCQ. MCQ
Okay.
now we'll do, we are done with the chapter, now we'll do MCQs. They can
Okay.
be either application based theory or it can be these calculations. Okay, tell me the target cost, tell me the cost gap in a scenario.
Okay. So mostly theory and mix of some practical. Yeah. Okay.
Yeah. So I think we are done with the chapter. We'll practice a few MCQs and we can close today also a little bit early. Next week onwards, I'll amp it up for you all and we'll be sitting for our full 4 hours. Today also still we can afford some time. All right. Yeah, I think we're done with the chapter. Any questions before we move to the LMS?
No, sir.
All right, just a moment.
Sir,
Yeah, ma.
actually the illustration one which you were showing in the book, it's not in my book and also not in ebook also.
Which question?
So the illustration one in the book.
Same is the issue with me. Illustration
This
one
one,
is
not
not
the
there.
service one.
Yes, sir.
Yes, sir.
Yeah, I added this time. So small change only. In the new books, it should be there, the ones which will get shipped to you. If you're an older book, yeah, this is one change. Because when it was only this much, which I want to give an example. I did add
You
it.
can take a screenshot and add it in the Excel so that we can.
Sir, we received books just 10 days ago. Still, this question is not there in our book.
You'll have to check with the team once. But if there's any issue, you PC me, WhatsApp me, I'll help out. But books ka you'll have to check with the team. Digital copy mein to it's there. So just check with the team and request a new book if there's any issue.
Okay. It's not in the digital copy as well. I have the digital copy from the LMS.
On the elements?
Yes,
Yes,
it's
sir.
not
It's
there.
not there.
Okay, 1 second. Actually, hub only. But yeah, basically I'll raise the query to the team. Digital though I'll have it updated today only. And what do you say? The physical one, I'll inform that some students had queries. And you all can also reach out to your mentors and I'll also have them informed, okay? Yeah, it's not added. Okay, I'll have the new copy updated on the LMS and I'll flag it to the team, all right?
Okay, sir.
Sir, what is not added?
The new book is not updated on the LMS, so I'll inform the team to do so.
Okay. Thank you, sir.
Yeah.
Sir, you have its PDF copy, so till they update, we get it on the group, like our doubts.
It updated in the what do you say right now only. I'll leave them a WhatsApp message, so you all will have it. All right.
Okay, sir.
So one question. In a previous example where we do the revision of P2 also, we are still getting some cost gap. So what we are going to do again? We will do the revision of cost or what?
Correct. That's why Sarnak, it's better to do the internal part afterwards because you don't know whether you'll achieve it. You'll have to keep doing it. So now they've done it and they still failed. So they'll have to figure another way. Okay, how do we further reduce the cost?
Okay.
Yeah, because it's theoretically you're supposed to close the cost gap, but reality में नहीं हुआ तो what will you do? You'll have to again go back and figure, or just then you open a different dialogue. Okay, do we do differentiation? Do we suffer with margins? Or do we revisit and figure a way to reduce maybe my material cost, whatever it can be? Okay.
Yeah, okay, got it.
All right. So let's do a few questions. We'll solve MCQ questions for half an hour and then we'll conclude for the day. Again, MCQ questions I like to ask you all only. So and whenever you're doing questions with me in class, ensure that we just don't correctly get the right answer. We understand whichever one is wrong also and why is it wrong. All right. Because ACCA exams have evolved now simply because they're computer based exams to now odds are that you will simply get a question where it says select all the ones that are true. So now even if you select two which are true and a third one is also true, you still will end up scoring 0 out of 2 instead of 2 out of 2. So every statement needs to be individually looked at rather than being confident that, okay, this must be wrong, so the others are right or stuff like that. Okay. All right. So which of the following statements about target costing is not true? Products should not be produced if there is a target cost gap. Anyone?
The first one is not true, I guess.
Not true, sir.
Why is this not true?
So the first one is true.
Why is it true?
Because when there is a cost gap, we do not produce because then it will hinder the selling price. So it's just because we cannot change our selling price.
But you can reduce your cost gap now.
That means you can make efforts to reduce it.
We can produce the goods after reducing the cost gap. Otherwise, we won't be able to sell our products.
Perfect. So the aim is not to not produce. Aim is to find ways to produce. Yeah. But let's see if those are true. Only then we know this is wrong. So a target cost gap is the difference between the target cost for a product and its projected cost. True or false?
True.
True.
Fundamental learning. Target costing is better suited to manufacturing industries rather than service industries that have a larger fixed cost base. True or false?
True.
Are we saying true because we already have a false, or are we clear why?
It is having heterogeneity also, so we can't exactly measure.
Yeah, we saw the reasons why service makes more difficult, not impossible, but more difficult. It's always suited more towards manufacturing. So it's true. Cost gap will be reduced in target costing by removing product features that do not add value. Is this a valid way to reduce cost gap?
Yes.
Yes, sir.
Yes, sir.
Correct. So our answer seems right. Right? Again, if you see, you don't have to rote learn any of the points, but you need to understand the points. You need to understand the method to be able to get an answer correct. We'll do 5, 6 of them. The rest will be homework for you all. Okay. So a company has a target markup of 25% and sells into a competitive market where the selling price is 120. The company's current cost per unit is 46 for variable cost and 60 for fixed cost. It has a budgeted output of 10,000. Question is not for a cost gap. The question is, what is the minimum production required to close the cost gap? Let me ask you one thing. What does this $60 represent?
OA,
unit.
OAR.
OAR. And OAR changes depending on the number of units.
Yes.
Yes, sir.
So you can reverse and find out the total fixed cost, which will not change. And you will need to see at what quantity level will the gap be closed. Correct? Take a few minutes, try it, and then I'll do it for all of us. Try and see if you can get to the answer by yourself.
12,000 units.
Seems so. We'll check it. Just take this to our Excel. Try and see what's given to you. Try and see what you need to find. I'll give you all one hint. So, target cost calculation, exactly the same thing we have learned so far. So, let's at least do that. What's my target selling price, anyone?
120. 120.
Using that, what's the target cost that we need to arrive at?
96.
90.
96.
If you have trouble arriving to 96, then margin markup needs a check. Here also, again, it's a markup. So cost is 100, markup is 25. So my selling price is 125. 100 divided by 125. Okay. What is my production cost currently?
106. 106.
Correct. And what will be my cost gap currently?
10.
10.
But for the question to work, close the cost gap. So I'll have to assume my cost gap needs to be 0. Correct? Basically, I need to go from 96, 106 to 96. Now, in my production cost, I have a variable cost. Will this variable cost change?
Yes.
No.
Variable cost remains the same. It's variable.
Yes, sir.
Yeah.
Won't change.
My fixed cost is where I have a way to reduce my cost gap. So if my fixed cost is 60, my total adds up to 106. But if my fixed cost reduces by the cost gap, which was 10, and becomes 50, then my cost gap truly reduces. And how do I facilitate that? Remember, it's only a overhead absorption rate. What is my actual total fixed cost? How do I find my total fixed cost?
10,000 multiplied by 60.
60 multiplied by 10,000. This is the payable. The company assumed that they have 10,000 units to sell, so the fixed cost becomes 60. Correct? So now we are just playing around with the formula. We are saying, okay, if the fixed cost is 6 lakh and that's not going to change, but I want my OAR to be 50. How many units do I sell?
12,000.
So it's 6 lakh divided by 50. 12,000 is my answer. This is again application of what we've learned. I have never taught you, okay, OAR ko aise reverse bhi we can do. But that we'll have to bridge the gap to come to what the question is asking us. All right? Yeah, Zoeb.
Sir, how did you reduce the fixed cost by 10?
So my cost gap was 10, right? Is there a way to change my variable cost? No.
No.
So fixed cost needs to reduce by the cost gap. So my target fixed cost, if you would like to put it, needs to be 60 minus 10 as 50. That's when my total is 96 and my cost gap is 0.
Okay.
Okay, this will help. So I'll say desired OAR is 50. So units to sell to get to that desired OAR is 12,000. Any confusion, anyone?
How can we change fixed cost?
You see the total cost is not changing. You're still paying 6 lakh. That's why I told you, right? OAR is just a rate, not the cost. The cost is fixed and it's still 6 lakh. I am just saying, can I make more units distributed amongst more units and have my per unit cost go down? Make sense?
So
If
that
for example,
50, why if we change it to 50? Is that now variable cost we cannot change? I didn't.
no, so the question also says, right? I mean, close the cost gap. When I produce 12,000 units, my fixed cost becomes 50 and my cost gap closes. Variable is variable for a reason. Na? So first you try and address at fixed level, see if that's possible. Then you go into variable and find the whole redesign that we discussed. Okay, can I find a way to do a variable cost also? Correct?
Understood.
Here, as per the question, they are trying to reduce it by improving the quantity sold. Whether it will happen or not is still up in the air. But we are just following what they ask us to. So I'll check 12,000. And that's your answer. Do a few more.
Sir, just want to note down the answer for the first one. Yes, sir. Okay, sir.
Yeah. Harshita, this is not economies of scale. Economies of scale is when you produce at such a scale that essentially you find cheaper ways to do it. Correct? Basically buying in bulk, producing in bulk. This is simply division. If you produce more units, your cost gets divided amongst more units. All right. Okay, there's a life cycle costing a question here. We'll see that next time. Okay. All right. So they are asking us to arrange the steps in the order of the process. So what is the very first thing we do in target costing, guys?
Determine the selling price.
The selling price.
Determine the selling price. What then?
Profit.
Determine the profit.
Determine
The
the
required profit.
required
Third,
Target
cost.
Target cost.
then
Sir, you have taken cost gap.
the target cost. Then
perfect.
then calculate the
Current
estimate current
Calculate the estimated current cost.
last is cost.
then gap.
Fair enough. Simple question.
Yeah.
All right. Okay. After this, we'll try and find more calculation questions. But yeah, let's see this. Which of the following would be an appropriate strategy to reduce cost gap in a competitive industry with demanding shareholders? So which of these are our options? Can I reduce the desired profit margin?
No.
No, sir.
No.
Why not?
So because the shareholders expect more profits to be made, and doing that would not
Correct.
make sense.
Demanding shareholders, even the question says so. So I can't just say settle for less. Reduce the expectation gap by reducing the selling price.
No, sir.
No, sir.
No, sir.
Acha, reducing the selling price will further increase my cost gap or further decrease my cost gap?
Further increase.
Increase.
Is
So it's actually more negative. Okay, because lower selling price may say you remove margin, so your cost gap will also increase more. Okay, so this is definitely not an option. Automating production in order to reduce average production cost.
Yes,
right.
we
Yes,
can
sir.
do this.
Yes, sir.
Yes.
Sounds about right.
Yes.
Increasing the selling price, of course.
No.
Not competitive then.
Yeah, perfect. All right. Let's do a few more practical questions, get practice in as well. You can try these questions. Wait. Yeah, there's an interesting one. So, predicted selling price for a product of company Zane has been set up at $56 per unit. Desired markup is 25%. Material cost is $16 before allowing for additional materials to allow for shrinkage of 20%. For every 10 kilos of material going in, only 8 kilos comes out. Correct? If labor is the only other cost and 2 hours are needed, what is the most the business can pay per hour if a cost gap is to be avoided? So there in the previous question, we had to seek a balancing figure में what's the fixed cost that we can allow. Here we have to see what's the labor cost that we can allow. So same exact thing you'll need to do. Find out the target cost. Assume that the cost gap is 0. Find out the material cost and the balance needs to be your labor cost. Now remember, your labor cost will represent 2 hours of labor. So your cost per hour will be divided by 2. Again, try it first, then we'll do it all together. Try and see if you can arrive at an answer. Kushbu, that seems right. Take your time, guys. We don't have any rush. Parul, I'll be solving it in a few minutes. Don't worry. So the only trick here is to correctly getting the material cost because there is some shrinkage involved. So you need to see how do I take the full material cost. Let me check again. Let's wait for a few more answers. Arya, that's close. I think you made a calculation error. Just check it. Umang, that's correct. All right, I'll also just set it up for us. So my target selling price is 56. What's my target cost?
44.8.
44.8.
4.8.
Hoping no one had an issue arriving here.
Yes, sir.
We've practiced it enough. Cost gap needs to be 0. Correct? So what should be my production cost also? 44/8. Only then the cost gap needs to be 0. So only two elements in my production cost, material and labor. Correct? So material is the only trick because the balance is going to be your answer. Right? So, yeah, Nikki. Nikki, you have a question?
Sir, where is the 44.8 comes from?
So there's a
Charge.
25% margin. So if you apply that on 56, you'll get
Yeah.
44.8 as your
Oh,
cost.
okay, thank you.
So material and labor now. Material mein what are they saying? $16 before shrinkage of 20%. 20% so they've also quantified okay, for every 10 kilos, 8 kilos comes up. So 60%, sorry, $16 represents 80% of the output. But you wouldn't want 80% of the product, you want 100% of the product you're buying for, correct? So it is simply 16 into 100% divide by 80% or simply 100 divided by 80 or 10 by 8 or whatever way you want to do it. So it is $20. Okay. If some of you fell for the trap and did 16 into 1.2, that will be wrong. Because again, if you see shrinkage here, you will end up not getting 16 back. So you can cross check it for yourself. From 20, when I remove 20%, I get my answer as 16. So you all can see for yourself. If you just do into 1.2, you do not get the right answer. Material, once again to repeat, you take $16, which represents 80%. You want to have 100%. So 16 into 100 divided by 80. Okay. So my labor is the balance, 24.8. Now this would be the answer. But the question says maximum rate per hour. How many hours of labor am I putting in my production?
2.
So if you remember our cost card, 2 hours into dollar cost per hour we were taking, right? That dollar amount is what this question is asking. So that is nothing but 24.8 divided by 2, $12.4. This is my answer. Only getting it right till here and still losing 2 marks is not what we want. Reading the question carefully is the only way to get it right. Let's just check. Okay. Please glance. Let me know if there's any questions. We'll do one more question. I think we can
Sir,
be
can
early
you
for the
please
day.
do it again as
Sir,
in quite
please can you
got
explain
it?
where this 24.8 comes from?
Sure. Karthik, which part are you confused in?
Sir, the material one. I actually
Sure.
didn't quite got it.
Sure. So if you read this line, $16 before shrinkage. Take something like a leather jacket. It shrinks when you go through several processes of production. So you would still want what you're paying for, right? So if $16 represents 80% and you want to buy 100%, I have to do it, convert it into 100%, right? Okay, when I put in $20 worth of product, shrink होने के बाद, I will get my 100%, which a consumer wants. So that cost of putting more so that you can account for shrinkage is represented by this. Clear?
Yeah.
Got it, sir.
So
Then
you're
it's a
saying
simple, yeah, nothing.
you're saying that $16 represent 8 kg, not 10 kg.
Correct.
Right. Okay.
So 16 represents 8 kg, you want 10 kg. So again, same thing. Right. Okay. And let's just write consumer wants 100%, not 80% of the. Okay. And then the rest is just the balance. If my total cost is 44.8 and my material is 20, my labor needs to be 24.8. So per hour, I can only afford to pay my labor $12.4. Yes. We are getting the grips of it. Any confusion? Should we move to one more question?
Sir, I guess there's a lag from your side. Last 30 seconds, you won't get clear.
Yes, actually it's the same.
Am I audible now?
Yeah.
Yes, sir.
Okay.
Sir,
No, I
how
was.
target cost is great.
Sorry, Ramanjit.
Hello, sir.
Yeah, go on.
Sir, how target cost is 44.8?
When you take the 25% markup on 56, you'll get 44.8. Yeah. Yeah, Grant.
Sir, 16 is before shrinkage, na? So then how is it not 10 kgs and it is 8
Before
kgs?
allowing for additional materials.
Okay.
So 16 represents 8 kilos. You want 10 kilos.
Understood.
Hope everyone's clear. Let's do one more practical question.
Sir, I have doubt in this. Why we are ignoring that shrinkage here?
Why we are?
And not considering the shrinkage. We are including that shrinkage as well. Why is that?
That's what we're doing now. We're considering the shrinkage. 20% gets shrunk. So we are putting in more material so that shrinkage ke baad you're left with 100%. Say, for example, you're paying for 1 liter milk, but in the process, 100 ml gets evaporated. So I am costing for 1.1 liter so that after evaporation, you get what you deserve.
Okay, sir.
Yeah.
Understood.
Okay, last question. The sales price of product Ruth is said to be $250. Sales volume is 500 units. If the company requires a return of 15% on its investment of $250,000, then the target cost is what? So here, the target profit is not given to you as a markup or margin. It's given to you as a return on investment. So you all need to find out in dollar terms, what's the target profit deducted from your target selling price, and you all will have your answer. So again, try it first, then let's discuss it together. This should be a simple one, but again, try. We've not done such a question before. And find out the target profit per unit and deduct it from your target selling price. So do it. Safwana, that's correct. Arya, Bhavika, that's correct. Khushbu, you'll need to answer from one of these four. Yeah, Khushbu, that's correct. Sonali, that's correct. Harshita, correct. Sanjana, correct. So in these cases, now try sending me the answers on direct message. So if anyone's still solving, they shouldn't know the answer. Lakshi, that's correct. Take another minute or two, guys. Solve it. Then I'll solve it for everyone in class. Umang, that's correct. Nitya, that's correct. Right. Ryan, that's correct. So good going, guys. So here it's all about target profit. Target selling price is to 250. For target profit, we need to do a little bit of work. So how much does the company want as a return? 15% on 250,000.
Yeah.
So they want to earn 37.
57,500.
So how much do they want per unit? They are going to sell 500 units, right? So to earn that 37,500 per unit, they will have to make 75 in profit. So target cost becomes 175. Is that clear? These are the combinations in which a topic like this gets tested. And hopefully what we discussed yesterday, you are getting the hang of it. The topic can be tested in any way, but core will remain the same. Let's just check it. All right. So I've done roughly half. Half I'll leave for you all to try. Of course, if there are ever doubts, you all can WhatsApp me. Happy to solve them. But if I do every question, then you all will be left with no questions to practice. So some questions, I try and do 30-40% of all topics in class. Rest is for you all to do as homework. Right?
Sir, can you go back to the Excel sheet, please?
Sure.
Yeah,
So can you
please.
explain
Thank you.
question 8?
Biplab, you have another question?
Yeah, question 8 actually, I was going to question 8. Can you
Which
can you solve that? Question number 8.
Wait, let's move to another one after. Question 9, any doubts? Is everyone clear with question 9?
Yes, sir.
Yes, clear, sir. Thank you.
Or
Okay,
anything
perfect.
specific you would like that we should do during the week?
This week will be relatively light for you all since it's the only first chapter that we've done. So I'll send you all a weekly plan, but it will primarily be to revise target costing, solve the remaining questions. So I'll send it as a message on the group. Okay.
Yes, sir.
Sir,
Mm-hmm.
sir, I want to ask you apart from this topic. सर आपने कल बोला था कि रिजल्ट आने के बाद आई शुड वेट फॉर ऑडिट एंड एफआर जो मैंने पेपर दिया था सितंबर में and उसके बाद I should decide. But sir, like I have a doubt. Like I am skeptical about FR result. So अगर मैं अभी FR prepare करना start करूँ,
Let's finish with the portion for the day. This you can just take up one-to-one with me. Let's not take that classes time, all right?
okay sir.
Just WhatsApp, happy to do these things one-to-one so that it's better for you as well and the class as well. Okay?
Fine sir. Okay. Thank you.
All right. Okay, what is this? Which of the following does not relate to target costing? All right. Value analysis, variance analysis, functional analysis, activity. So again, we have to cover all the topics, but if I'm to guess, value analysis is related to target costing, correct? Variance analysis should be related to target costing because again, like we discussed, it's a comparison of actual and budget. Functional is just like value analysis because again, it is what functions are there in a product and not. Should be activity analysis. So, any questions that you come across covered the portion, just mark it and again, like I said, PM is a mix of all topics. So once we cover all topics, some mix and match questions you'll be able to address. All right, Bipin?
Okay. Thank you.
All right. Any questions before we conclude, guys?
Yes, sir. Can you show me in LMS where I can see this question bank and Excel sheet which you make the notes today, where we can see that in the LMS?
Sure. So if you open your practice hub, there are section A questions in which there is target costing, which is what we have. Okay. For you, it will be start quiz.
Okay.
And notes, after we conclude the lecture, I'll be uploading it in our batch under class notes. Okay, so when you come to this tab of class notes, 1 second. Right now you see this is empty. You'll see both the Excel sheets of today and yesterday. You can download them.
Sir, can you share these Excel sheets on group also? I didn't have LMS access yet.
If you all want, message me. I'll just right now only simultaneously message the Zell team to add you all on the LMS. But I'm not permitted to upload anywhere except the LMS. So 1 second. Wait, putting the message.
Yes,
So
Sir, even for the updated notes.
Yeah, 1 second. Who does not have access to the LMS? If you can raise your hands. Okay, I'm sending the message. 1 moment. Anyone else who's not yet gotten an access, I'll just take a photo. Okay.
Sir, me also.
Parul, Nithya. Okay, anyone else? Okay, I've informed the team. I'll take an update from them, but I'll get them to add you today only. Nice, not have access to elements. Ranjit. Okay, 1 second. It's weird, a lot of you don't have.
I just got yesterday, sir, but I didn't get the onboarding session, so I don't know how to use the LMS.
Do you know how to use it now from what I mentioned?
No, I can get to know now after you mentioned.
Perfect. All right. And notes, I'll have it updated shortly. Once notes are updated from my end, I'll put a message on the group. All right.
So I have the excess of LMS, but this batch is not showing in my LMS.
Okay, 1 second.
Same problem, sir.
Same, even I'm on the
Wait,
same problem.
When don't have either batch access or LMS access. Request. Okay, so I'll get this done. Don't worry, and notes I'll have it updated. Okay.
Okay, sir.
Anything else from my end, guys, before we conclude for the day?
No, sir.
No, sir.
Okay, perfect. All right then. So from my end, I'll be putting on a message once the notes are added today itself. Tomorrow morning, I'll put in a short plan for the week. This week, you all don't have much, so you all can still take it light. Next week onwards, class will be full 2 to 6, and we'll have much more to do during the weekdays. This week is still relatively chill for you all, so take it easy, and then we can amp up our PM plan. All right. So I'll see you all next Saturday then, guys. Thank you so much for today. Bye-bye.
Bye,
Thank
sir.
you.
Thank you,
Thank you,
sir.
sir.
Bye, sir.
Thank
Thank
you
you.
so much,
Bye,
sir.
sir.
Thank you.
Have a nice
Sir.
You're welcome. Bye, guys.